Please like, share, and subscribe. Wishing you happiness and good luck every day.
Welcome to The Explainer. Today, we're going to break down the absolutely legendary half-century business career of Warren Buffett, but we're going to do it through a really unique lens, the eyes of Fortune magazine. This is the story of how a man from Omaha built a global empire on a set of principles that were, in his own words, simple, old, and few. You know, this one phrase really gets to the heart of his whole philosophy. The idea of finding so much joy and purpose in what you do that you literally feel like you're tap dancing to work. It's a theme we're going to see again and again. This idea that your career shouldn't be a grind, but something you're truly passionate about. So, to really get our heads around his blueprint for success, we've broken his story down into 5 key parts. First, we'll look at the incredible relationship between the oracle and his scribe. Then we'll dive into his actual blueprints for investing and for managing. After that, we'll check out the masterclass in communication that were his famous annual letters. And we'll wrap up by looking at the legacy he's building by giving it all away. Okay, so to really get the Buffett story, we have to start with how the story was told. Because this isn't some biography written years after the fact. Nope, this is a chronicle, captured in real time over almost 50 years. What makes this so special is that it's basically a living, breathing business history. It was all compiled over decades by the journalists at Fortune. So you get to see his ideas, his company, and his whole philosophy evolve right alongside the American economy itself. It's pretty amazing. And this timeline, man, it just perfectly lays out the sheer scope of the coverage. I mean, it starts way back in 1966 with a single sentence where they misspell his name Buffett with 1 T. It's a perfect little reminder of how unknown he was. And from there, it tracks his entire journey, all the way to him becoming a global icon. And here's the kicker. This was not some reporter looking in from the outside. The main writer, Carol Loomis, was Buffett's close friend for over 40 years. She was a shareholder in his company, and she was the person he trusted to edit his legendary annual letters. This incredible relationship gave her, and by extension all of us, this completely unparalleled access. So, the big question, right? How did this guy become the most successful investor in history? Well, his blueprint starts with something really simple: rejecting what everyone else was saying. While all the academics were preaching one set of rules, Buffett was out in the real world, proving them all wrong. So on one side, you had this theory that totally dominated the business schools called the efficient market hypothesis. It basically said the market is so smart you can't consistently beat it. But then you've got Buffett, and he spent his entire life proving that you absolutely can by hunting for what he called pockets of inefficiency, those moments when the market just gets it plain wrong. So what did the academics do? How did they explain this guy who was breaking all their rules? Well, one famous professor looked at Buffett's insane track record, and instead of questioning the theory, he basically just threw up his hands and called Buffett a 5 sigma event. Okay, let's just put that into perspective. A 5 sigma event is a statistical term for something so rare, the odds of it happening by pure chance are about 1 in 3.5 million. So instead of admitting their theory might be flawed, they were basically saying his success was just impossible, miraculous luck. Buffett, of course, disagreed. His early approach was anything but random. He called it the used cigar butt approach. He'd find these awful businesses that were so unbelievably cheap, they were basically free. You know, they were soggy and gross, but there was one last free puff of profit left in them. But he didn't stick with just cigar butts. As he evolved, his philosophy centered on this idea of intense focus and discipline, which he captured in this famous 20 punch card analogy. Imagine you could only make 20 investments in your entire life. You'd be incredibly careful, right? You'd only swing at the absolute perfect pitches. That's the point. You don't need 100 ideas, just a few great ones. But here's the thing about Buffett. He wasn't just a stock picker. His real genius, his masterpiece, came when he switched from being an investor to being a manager, building one of the world's biggest companies from the ashes of a failed textile mill. He literally thought of himself as an artist, and Berkshire Hathaway was his canvas. And his tools? They weren't complicated business school theories. No, he relied on a handful of simple, timeless principles. It was proof that you don't need complex methods to get extraordinary results. And you can see this so clearly in what was basically his businesses wanted ad that he put in his annual reports. He wanted simple businesses he could understand. Businesses with a solid track record, good finances, and, this is key, great, managers already in place, and he wanted a price up front, no messing around. It's a total masterclass in how to buy a business. You know, his longtime partner, the brilliant Charlie Munger, once boiled their entire philosophy down to a single word: rationality. In a world that's so often driven by ego and emotion and just following the herd, their ability to stay consistently logical was their superpower. It sounds simple, but it's incredibly hard to do. All right, so one of Buffett's most powerful tools wasn't in his bank account. It was his typewriter. His annual letters to shareholders became this absolute must-read for people all over the world. It was like a free education in business delivered once a year. He taught millions about business using this folksy wisdom and a great sense of humor. Like here, he's making fun of how complicated accounting had become, joking that maybe we should go back to a simpler system. It was this ability to make complex stuff simple and even funny that made the letters so powerful. He was also brutally honest, especially about his own mistakes, and he used these sharp analogies, like this one, to call out bad behavior in corporate America. He's talking about managers who, instead of hitting a target, just shoot an arrow anywhere and then draw the target around it. It was a brilliant call for integrity and honesty. So after you've conquered investing, after you've built this massive empire, what's next? Well, for Buffett, the final act of his blueprint was all about legacy. It was about making sure that the incredible fortune he built would go back to society in the smartest way possible. And then in 2006, in an exclusive for Fortune, he announced a plan to give away almost all of his money. The initial pledge was for over $30 billion. At the time, it was the largest single charitable gift in human history. But, and this is so quintessentially Buffett, how he did it was just as important as the amount. He didn't just write a check. He treated it like an investment. He wasn't trying to build a monument with his name on it. He was looking for the highest possible return for society. And this quote just lays out his logic perfectly. Why reinvent the wheel? He looked around and saw the Bill and Melinda Gates Foundation as the most effective company in the world for solving huge problems. They had the talent, they had the track record. So in the ultimate act of rational thinking, he decided to invest in them. So when you look at the whole picture, the investor, the manager, the philanthropist, his whole life is a blueprint built on just a few core ideas. He managed with logic, he communicated with honesty, and he gave his wealth away with disciplined analysis. So the question we're left with is which one of those pillars, rationality, patience, or integrity, is really the most powerful? That right there is the heart of the Buffett blueprint. All right, let's dive into the story of one of the most influential investors you've probably never heard of. This is about a man whose ideas completely reshaped the world of finance, and he did it all while staying completely in the shadows. Everything really kicks off with this number, 670%. Just let that sink in for a moment. This was the incredible 10-year return from a single private investment partnership, ending back in May of 1965. A number this huge just makes you wonder. You know, because this kind of mind-blowing performance didn't come from some famous publicly traded mutual fund that everyone knew about. Nope. It was the quiet work of a man who was rarely photographed, a guy who was, for all intents and purposes, a ghost on Wall Street. And just to put this into perspective, that 670% return didn't just beat the competition, it absolutely crushed it. It nearly doubled the performance of the Dreyfus Fund, which was celebrated as the best mutual fund of that entire decade. So the big question is, who was this phantom genius? Well, his name was Alfred Winslow Jones, and look, to call his journey to Wall Street unconventional, that would be a massive understatement. His background was about as far from finance as you could possibly get. Yeah, Jones wasn't your typical Wall Street guy. No banker background, not a trader, not an economist. He was a sociologist with a PhD from Columbia and a journalist for Fortune magazine. He wrote about everything from farm life to wartime convoys, and he saw the world as this complex, interconnected system. And it was exactly that academic, analytical eye that he eventually turned towards the stock market. It was one freelance article he wrote about technical market analysis that just changed everything for him. He got totally hooked and became convinced he could apply his skills to the market itself. So in 1949, he got 4 friends together, they pooled $100,000, $40,000 of which was his own money, and A.W. Jones & Co. was born. So how on earth did a sociologist with a pretty small pile of cash manage to generate these unbelievable returns? Well, he didn't just play the game better than everyone else. He went out and invented an entirely new way to play. The absolute core of his system was the hedge, basically a way to protect your money if you guess wrong about which way the market is heading. Now, back then, a conservative investor would hedge with something safe, like cash or bonds. Jones, he did something completely different. He decided to hedge the stock market with the stock market itself. And this quote right here, this was his whole philosophy in a nutshell. He took tools that most people saw as pure speculation, as dangerous, and he used them not to gamble, but to build a fortress around his capital. Okay, this slide is the heart of his machine, so let's break it down. On the left, you've got a conventional investor with 100 grand. They might put 80,000 in stocks, so their risk exposure is 80%. Simple enough. Now look at Jones's method on the right. He takes the same 100 grand, but then he borrows another 50,000. He invests 110,000 in stocks he thinks will go up. That's going long. But, and this is the absolute genius part, he simultaneously shorts, or bets against, $40,000 worth of stocks he thinks are going to tank. So while he has more money in the market, his actual net risk exposure is only $70,000. Think about that. He's using more capital with less overall market risk. It's brilliant. This structure was totally revolutionary. It created a portfolio that could make money whether stocks went up or down. Those short positions acted like a built-in shock absorber for market crashes, and that safety net gave him the freedom to make much bigger, much more aggressive bets on the stocks he really believed in. And hey, the proof is in the pudding. Jones actually wasn't all that great at predicting the market's overall direction. He famously got super bearish right before a massive rally kicked off in 1965. But you know what? It didn't matter. The system, the hedge, it protected him from his own bad calls, and that allowed his brilliant individual stock picks to shine through and just rake in those incredible returns. But this brilliant investment theory was really only half the story. The way he structured his firm was just as innovative, and it gave him a massive competitive advantage. His firm was basically built for speed and performance. By staying private, he could move fast, free from all the heavy regulations that bogged down public funds. That famous 20% performance fee meant his interests and his investors' interests were perfectly aligned. He only got rich if they did. He also used his trading commissions as a currency to buy the best, smartest research on the street. And finally, there were no committees, no bureaucracy. His managers could act on a great idea instantly. And get this, that incredible 670% return we keep talking about, that's the net number his investors actually took home. That's the figure after Jones and his partners had already taken their massive 20% cut right off the top. It means the gross performance of his portfolio was even more mind-boggling. This give-up system he used was just pure genius. See, mutual funds had to use their commission dollars to pay brokers for selling their fund to the public. Jones didn't have a public fund to sell, so he could use 100% of that money to pay for the one thing that truly mattered, the best, fastest research ideas. He basically built himself an exclusive information pipeline that made sure the smartest ideas on Wall Street landed on his desk first. For almost 20 years, this was a totally private, secret success story. But in 1966, a Fortune article came out that exposed his methods, and it was like lighting a match. Jones's quiet little experiment was about to go global. That article just spread like wildfire through the financial world. It became this unofficial prospectus, a public blueprint for his new kind of fund. And suddenly, everybody wanted in. Former associates left to start their own partnerships, and the hedge fund industry was basically born overnight. And just look at the kind of people who were investing with him. This wasn't just old Wall Street money. His partners were this incredibly diverse and sophisticated group, from top industrialists and a world-famous bridge expert all the way to the author of a biography on Lenin. They all recognized the sheer brilliance of the system. And here is just a fantastic piece of financial history. In that same groundbreaking article, the author, Carol Loomis, mentioned another successful private partnership operating out of Omaha. The only tiny problem? She misspelled the manager's now legendary name, writing Buffett with one T instead of two. Yup, that's Warren Buffett. Which really leaves us with this final, fascinating question. Alfred Winslow Jones, the sociologist turned investor, never wanted the spotlight. He was just a guy trying to use speculative tools for conservative goals. And yet, in doing so, he created a model that would spawn a multi-trillion-dollar industry and completely change the very nature of financial markets forever. What if the greatest investor of all time quit right at the absolute peak of his game? Well, that's exactly what happened. Today, we're going to dig into one of the most puzzling moments in financial history, the year Warren Buffett decided to walk away from it all. I want you to just picture this for a second. You're 39 years old. You've built one of the most successful investment funds in the entire country. You're outperforming pretty much everyone. You're a multimillionaire. By every single metric, you are winning. So what's your next move? You cash out, you liquidate everything, and you walk away? That is exactly what Warren Buffett did in 1969. And the big question has always been, why? All right, so here's how we're going to unpack this. First, we'll set the scene and talk about the totally chaotic markets of the late 60s. Then we'll zero in on the one guy who was somehow crushing it. After that, we'll get into his shocking decision to get out. And finally, we'll use a little bit of hindsight to figure out what it all really meant. To really get Buffett's decision, you first have to understand the world he was living in. Because the late 1960s, they were a time of some serious financial whiplash. The speed of this reversal was just stunning. I mean, 1968 was a full-blown party. It was a wildly speculative market. People were making extravagant profits. It was just crazy. But then, the very next year, boom, the hangover hit, and it hit hard. 1969 brought a rough bear market. And all those clever hedging strategies that were supposed to protect everybody, yeah, they totally fell apart. And listen, this wasn't just some minor dip in the market. The hot new things on Wall Street at the time, these hedge funds, they got absolutely hammered. Most of them were deep in the red. Investors started panicking, pulling their money out in huge waves, and some funds just went out of business, gone. It was a complete and utter mess. But in the middle of all that carnage, there was this one outlier, an investment partnership that wasn't even based in New York. It was in Omaha, Nebraska. And it was playing by a totally different set of rules. And you know what? It was still winning. Big time. I mean, just look at these numbers. The difference is staggering. Over its entire 13-year run, the Dow Jones returned about 7.4% a year. The Buffett partnership? It delivered a gross return of 29.5% per year. That's not just beating the market, that's like playing a completely different sport on a different planet. And this wasn't just one lucky year we're talking about. It was about relentless, unbelievable consistency. For 13 straight years, through all the ups and downs, his partnership made a profit. He never had a down year. Not once. Even in 1969, when everyone else was getting wiped out, he was still in the green. So, what did all that consistency mean for the people who actually trusted him with their money? Well, even after Buffett took his fee, and he had this unique structure where he only took a cut of profits above a 6% hurdle, his partners still walked away with a compounded annual return of almost 24%. Just astounding. Now, when you're posting numbers like that year after year, word gets around. This wasn't some tiny little firm. By 1969, he was managing over $100 million in assets. That was a massive amount of money for the time, and it just proves how successful his whole approach had become. And of course, he was doing pretty well for himself too. All that success had built him a personal fortune of about $25 million, and he was only 39. So let's just recap for a second. An unbeatable track record, huge assets under management, and personal wealth that most people can only dream of. He had it all, right? So what was his secret? Well, it wasn't really a secret. While the rest of the hedge fund world was busy chasing these quick, speculative profits, Buffett was doing something completely different. He was investing almost exclusively in what he called long-term value situations. He simply wasn't playing the same short-term game as everyone else. Which brings us right to the heart of this whole story. Because at the absolute pinnacle of this incredible success, Buffett made a move that just left everyone completely stunned. So, I'll ask you directly, you've got a 13-year winning streak. You have a reputation as a genius. Everybody wants to give you their money to manage. What's your next move? What do you do? He quit. He just closed it all down. He returned all the money to his investors, shut the doors on one of the most successful investment partnerships in the country, and just walked away. His explanation was almost shockingly honest and humble. He looked at all the speculation, the insane behavior of the market, And even though he was still winning, he just admitted, "This is a market I don't understand." In a letter he wrote to his partners, he basically laid it all out. He said the market had just lost its mind. He felt that finding great investments that could produce big gains was going to get a lot harder in the years to come. And on a personal level, he said he wanted to focus on other goals. He even suggested his investors might just be better off putting their cash into something super safe and boring, like municipal bonds. So, here's the big question. Looking back on it now, with over 50 years of hindsight, was he right to quit? Let's take a look. So, was he right? Well, the answer's a little complicated. It's kinda yes and no. In the short term, his timing was impeccable. The market did run into some really tough times, especially during the crash of 73-74. But his long-term pessimism about the stock market as a whole, yeah, on that, he was completely wrong. Stocks would go on to reward investors like crazy for decades. You see, closing the partnership wasn't him quitting investing forever. It was more like the end of one chapter. His caution was totally validated by that crash in the early 70s. But he didn't stay on the sidelines. He just pivoted. He turned his focus to this little struggling textile company he owned, Berkshire Hathaway, and turned that into his new investment vehicle, just in time to ride one of the greatest bull markets in history. And this, right here, reveals the deeper truth. You know that reason he gave about pursuing other goals? Well, that kind of faded away. Because for Buffett, it was never just about the money. Building wealth has always been, in his own words, an endlessly fascinating game. And in 1969, that game had become irrational and, for him, kind of boring. So he just stopped playing and waited for a new, more interesting game to begin. Which really brings us to this final thought. Buffett's decision teaches us something important. For the true masters of any craft, it's not just about the final score. It's about the quality of the game itself. And it leaves us with a pretty big question to think about. If winning isn't the only goal, then how do you define the game you're playing?
You know, sometimes the most relevant ideas come from decades ago. We're going to go back to 1977 to an article Warren Buffett wrote for Fortune magazine. And it wasn't just another article. It was a bombshell. He basically blew the lid off of a commonly held belief, showing in painful detail how inflation was quietly swindling investors right where they thought they were safest.
So let's be real. When prices are going up all around you, it's the number one question on everyone's mind, right? Where do you hide? When the cash in your wallet buys less and less each day, what are you supposed to do with your savings to protect them?
For generations, the answer from Wall Street was practically a commandment. Buy stocks. It was just what you did. It was seen as the settled, obvious move to shield yourself from a currency that was losing its value.
And the logic? It seems totally airtight, doesn't it? I mean, stocks aren't just tickers on a screen. They represent a piece of real things. Factories, brands, technology. So the thinking was, as dollars get cheaper, the value of all that real stuff would just get repriced higher. It was supposed to be the perfect shield for your purchasing power. But then, this article comes along from Omaha, and Buffett just methodically takes that entire shield and pulls it apart piece by piece. He argued that this comforting advice wasn't just a little bit off. It was a dangerous trap, silently destroying the capital of well-meaning investors. Okay, so Buffett's entire case really hangs on one powerful, mind-bending idea. He asks us to completely forget how we normally think about stocks, as these dynamic, growing assets. And instead, he says, for the sake of understanding returns, just imagine the entire American stock market as one single, giant bond that never matures.
This brings us right to the heart of his argument, something he calls the equity coupon. Buffett noticed something incredible when he looked at the data. If you zoom way out and look at the return on equity for all of U.S. industry over decades, it wasn't some wild, unpredictable number. It was shockingly consistent, always hovering right around 12%. And he said that stable return acts just like a fixed coupon you'd get from a bond.
And here's the proof. Just look at these numbers. We're talking about 3 totally different decades. You've got the post-war boom, the swinging 60s, and the tough stagflation of the 70s. And through all that change, the underlying profitability of corporate America just kept snapping back to this 12% neighborhood. It was like a law of financial gravity, and it's the anchor for his whole theory.
So you can see the huge mental flip you have to make. Our perception is that stocks are a claim on real assets with variable returns that should beat inflation. But Buffett's reality is that they act like a perpetual security, a bond that never ends, that just kicks off this surprisingly fixed 12% coupon. And once you start to see it that way, the whole inflation problem comes into sharp and frankly painful focus.
So as we move on, this new way of thinking immediately brings up a huge question. If this 12% return is the big problem, then why can't the smartest companies in the world just fix it? Why can't they just crank up their profitability to 16% or 20% and leave inflation in the dust?
I mean, that's the natural objection, right? Surely a great business can just pass on higher costs to its customers and protect its profit margins. But this is where Buffett really puts on his accountant hat and systematically shows why that's so much harder than it sounds. He lays out the only 5 ways a business can boost its return on equity, and then shows how inflation blocks every single path. Path 1, increase turnover. Sell more stuff using the same assets. It's possible, but the gains are usually pretty small. Path 2, use cheaper debt. No, inflation drives interest rates up, making debt more expensive. Path 3, okay, how about more debt? Also a dead end. Most companies were already leveraged, and adding more is just too risky. Path 4, lower income taxes. Buffett thought this was a fantasy, calling the government a first shareholder that always gets its cut. And Path 5, the most obvious one, just raise prices to get wider profit margins. Well, the data showed the opposite. Competition actually squeezes margins during inflationary times. So, the key takeaway? That 12% is a trap. There's no easy escape.
And this is where the whole thing really hits home. Buffett pivots from the corporate boardroom to your personal brokerage account. He says, okay, let's take that trapped 12% return and run it through the real-world gauntlet of taxes and inflation to see what's actually left for you, the investor.
All right, let's do the math together. We're going to start with our baseline, that 12% return on equity that corporate America is generating. This is the whole pie before anyone else gets a slice. So far, so good.
But of course, you never get the whole pie. The first hand that reaches in to take a slice belongs to the government. Any profits paid out as dividends or any profits you make when you sell are taxed. It's an unavoidable cost of investing. So once the tax man takes his share, that respectable 12% return gets knocked all the way down to about 7%. Just like that, more than 40% of the initial return has just vanished. And we haven't even gotten to the main villain of the story yet.
And here it is. This is the silent partner in your portfolio you never agreed to have. It's the phantom tax collector that takes its share every single day without ever sending you a bill. We're talking, of course, about inflation.
Back in 1977, a 7% inflation rate wasn't some abstract theory, it was the reality people were living every day. So that's the number Buffett plugs into his equation. We take our 7% after-tax return, and now we subtract that 7% inflation tax.
And what are you left with? Zero. A nice round zero. After the company does its job, after the government takes its cut, and after inflation eats away at your money, you, the equity investor, have made absolutely no progress. Your account statement has more dollars, but your actual purchasing power hasn't moved an inch. You've been running as fast as you can just to stand still.
And Buffett's summary of this is just chilling. He said the inflation tax has a fantastic ability to simply consume capital. It doesn't just skim your profits, it actually eats away at your original investment. It's a wealth tax in disguise, and it's brutally efficient at destroying your real wealth.
So now that we have over 40 years of hindsight, how did Buffett's dire warning actually play out? Well, this is where the story gets really interesting. Because in some ways he was wrong, but in the most important way, he was profoundly right.
See, the one thing Buffett didn't predict was the political will to stop inflation dead in its tracks. In 1979, Paul Volcker became the chairman of the Federal Reserve, and he did the unthinkable. He jacked up interest rates to painful levels, pushed the economy into a recession, and absolutely broke the back of inflation. By the early 80s, the beast was slain.
So let's be fair about what his forecast got wrong. He thought high inflation might be a permanent part of the economic landscape. It wasn't. He assumed corporate taxes would stay high. Instead, they actually began a long-term decline. And that seemingly unbreakable 12% return on equity ceiling? Well, it was eventually shattered, especially by the new wave of less capital-heavy businesses. But, and this is the absolute crucial takeaway, his analysis of the mechanics of inflation was flawless. For the exact period he was writing about, he was 100% correct. From the late 60s all the way through the early 80s, the stock market was a terrible place to be in real inflation-adjusted terms. His grim arithmetic perfectly predicted the lost decade for equity investors.
So what's the final lesson here? It's actually in a brilliant little note Buffett added at the end. After laying out this devastating case, he said he still owned stocks. Why? Because as bad as they were probably the best of all the poor alternatives. And that really leaves us with a provocative thought. Your true investment return isn't the number you see on your statement. It's what's left after your two silent partners, taxes and inflation, have taken their share. The real question for any of us, in any environment, is are we paying enough attention to what those hidden partners are costing us?
You've probably never heard of Grinnell College. It's a tiny liberal arts school in the middle of Iowa. But what if I told you that this small school, with the help of Warren Buffett, pulled off one of the most incredible investment plays of all time? We're talking about a strategy so bold it completely rewrote the rules for how universities manage their money.
Okay, let's just jump right in with a number that tells the whole story. While most universities were lucky to get a 1.7% return on their endowments, basically treading water, Grinnell College was pulling in 16.2%. That's what, almost 10 times higher? So the big question is, how in the world did this tiny school in Iowa do that?
All right, so here's what we're going to cover. We'll start with how improbable this whole story is, then get into the partnership that made it happen. We'll look at their completely unorthodox strategy, the one huge bet they made, the incredible results, and finally, the pretty wild legacy this all left behind.
So let's set the scene. We're in Grinnell, Iowa, a small farm town. You're picturing cornfields, right? And in the middle of all that is this tiny, really prestigious liberal arts school with maybe 1,200 students. You'd think their biggest concern is academics, but no. What makes them fascinating, for our purposes anyway, is their balance sheet.
And this is where things get really interesting. See, most schools grow their endowments when rich alumni write big checks. That's the standard model. But not Grinnell. Their fund basically doubled in just 5 years, and it had almost nothing to do with donations. It was all about how brilliantly they invested the money they already had.
So, if you looked at their books back in 1978, you'd see the endowment was worth about $37.5 million. And hey, for a school that small, that's a really impressive number. But, and this is a big but, that was just the official number, the public one.
The real value, the true market value, was way higher. Because of some of the unique things they owned, the official value was super conservative. The real number? It was closer to $60 million. 60! So you have to ask, how did they do it?
All right, so who are the wizards behind the curtain here? You know, most schools just hire some Wall Street firm to manage their money. But Grinnell did it differently. They kept it all in-house, run by their own finance committee. And really, it all came down to just two guys.
First, you've got Joe Rosenfield. He was an alum, class of 25, a retired lawyer, and a pretty sharp investor himself. He really, really loved the school. And then you have Warren Buffett. Yeah, that Warren Buffett. Now, Buffett had no connection to Grinnell. He was an alum. The only reason he was there, Joe Rosenfield asked him.
And Buffett later said, Joe is not the kind of guy you can say no to. He talked about how Rosenfield's generosity was just on another level. Most people give money away for the tax break. But Buffett said Joe was the one guy he knew who gave so much that you could actually see his net worth go down because of it. How do you say no to someone that committed? Okay, so we have the team. Now, let's talk about their playbook. And, well, unconventional doesn't even begin to cover it. They basically took the standard rule book for how you're supposed to invest in endowment and threw it right out the window.
This really lays it out perfectly. The old way, the safe way, was to diversify like crazy. Buy a little bit of everything, hire outside managers, and whatever you do, avoid risk. Grinnell? They did the complete opposite. They made huge, concentrated bets. They kept control themselves, and they ran toward big, calculated risks if they saw an asset that was seriously undervalued.
Now, this idea came straight from Buffett's mentor, the legendary Benjamin Graham. The core philosophy is simple. Find a company the market doesn't appreciate, and then invest a lot in it. But Buffett took it a step further. He wasn't just looking for a cheap stock to flip for a quick buck.
He wanted to buy pieces of wonderful businesses that he could hold on to, well, pretty much forever.
And here's a key quote from Buffett that explains everything. We don't have a lot of good ideas, and therefore we don't do a lot of things. Think about that. Their success wasn't about being busy. It was about being incredibly selective. It's like waiting for the perfect pitch. You don't have to swing at every ball. You can just stand there and wait for that one perfect opportunity.
So with this whole philosophy of wait for the perfect pitch, they made a couple of really amazing investments. But there was one big bet that would completely change the game for Grinnell College forever.
So, first, there was this bet on Intel. It helps when one of your trustees is Bob Noyce, a co-founder of the company. A $100,000 investment in Intel's early days turned into almost $12 million. I mean, that's incredible. But that was just the warm-up act. What Buffett found next was the main event. And it all happened so fast. In 1976, Buffett gets a tip. A company called Avco is selling off its TV stations. They try to buy the one in Cincinnati, but just miss out. So what does Buffett do? He doesn't waste a second. He immediately makes an offer on Avco's station in Dayton, Ohio, even before he had all the financing lined up. That's classic Buffett. When the perfect pitch comes, you swing for the fences. The price tag was $12.9 million. Now, to put that in perspective, that was about 2.5 times what the station was making in revenue. For Buffett, that was a great price for the kind of cash cow business he loved. But that purchase price, it's not even the most amazing part of the story.
No, this is the most amazing part. Grinnell didn't actually pay $12.9 million. They only put down $2 million in cash. $2 million! The rest, they borrowed it. This is leverage, my friends, and when it works, it's like pouring rocket fuel on your investment.
And boy, did it work. That tiny $2 million investment from the college gave them control of an asset that, just a few years later, was worth around $35 million. That's more than double what they paid. It was an absolute out-of-the-park home run.
So the results were stunning. I mean, this was life-changing money for the college. But funnily enough, their massive success created a brand new problem. A really tricky one, actually.
Take a look at this. The TV station had become so valuable that it was now roughly half of the entire endowment's worth. Think about that. Their single greatest investment had also become their single biggest risk. All their eggs were basically in this one very profitable basket.
And this sparked a huge debate on the board. The trustees had a legal duty to be prudent, to protect the college's money. So they had to ask, is it actually responsible to let one single investment make up half our portfolio, even if it's a massive winner? The pressure was on. Should they sell it and lock in the gains?
So while some of the trustees were, understandably nervous about all this concentration, Buffett was thinking on a completely different level. He wasn't worried about the risk. He was thinking about the opportunity. He was already looking way, way down the road, thinking about what this incredible new wealth could mean for the college's future. And this is the legacy, the big idea he left them with. He painted a picture of a future where the endowment was so powerful it could fund the entire school. A future where Grinnell College could become so wealthy from its investments that it wouldn't need to charge tuition at all. A completely free, elite education, paid for by one brilliant, audacious bet. What a vision, right? All from a little school in the middle of a cornfield. So when you hear the name Warren Buffett, what comes to mind? For almost everyone, it's legendary investor, right? But what if his greatest legacy isn't actually his stock picks, but a totally radical philosophy of management? Today, we're going to dig into Buffett the CEO and his core idea that shareholders aren't just line items on a spreadsheet, they're partners. Let's see what that actually looks like when the rubber meets the road. Just think about that for a second. Seriously. What if the person running a giant corporation genuinely believed that every single dollar sitting in the company's bank account was, in a very real way, your money? Well, that one simple question, it's the key that unlocks one of the most fascinating experiments in the history of business. So here's how we're going to explore this whole philosophy of partnership. We're going to look at two totally different case studies. First up, a groundbreaking and, as you'll see, super controversial charity program. And then we'll dive into his world-famous letters to shareholders, which completely blew up the idea of what an annual report is supposed to be. All right, let's kick things off with this wild 22-year-long experiment that just completely flipped the script on corporate giving. See, instead of the CEO sitting in an office deciding where the company's charitable donations should go, Buffett had a different idea. The owners of the company should be the ones to make that call.
You know, the logic here is just so simple, it's almost impossible to argue with. That's what makes it so powerful. Buffett's whole point is just, hey, it's your money, so you should be the one to decide. This wasn't some complex financial trick. It was a really powerful, principled stand on what ownership actually means.
And here's how this whole charitable dividend thing actually worked in practice. The company would set aside an amount for every share. Let's say it was 18 bucks. Then every single shareholder could tell Berkshire where to send their portion of that money. Berkshire handled all the paperwork, they sent the check, and, get this, because it was a corporate donation, it was tax deductible. That meant even more money went straight to the actual cause. It was democratic, it was efficient, and it put the power right in the hands of the owners.
And listen, this was no small-time garage experiment. Over 2 decades, Berkshire shareholders directed almost $200 million. That money went to thousands of different places, from local churches and animal shelters to major universities. That number isn't just a statistic. It's the real-world proof of what happens when you actually put this philosophy into action.
But as incredible as the idea was, it eventually slammed into a real-world conflict that nobody saw coming. And it was a conflict that would force Buffett to choose between his principles and his people.
This timeline shows just how fast everything went off the rails. It all started with a petition protesting that some of the shareholder-directed money was going to pro-choice groups. But the pressure just exploded, and it shifted, targeting the 70,000 freelance consultants of Pampered Chef, which was a Berkshire Hathaway company. All of a sudden, their home businesses, their actual livelihoods, were at risk.
And here is the craziest irony in this entire story. Just 1 year before the whole thing was canceled, a shareholder proposal to end the program was defeated, with 97% of the vote. The very owners the program was built for overwhelmingly loved it. But the real-world pressure was being put on a totally different group of people.
So, in the end, Buffett made a really tough call. He shut the whole program down. Why? Because the fight wasn't about corporate policy anymore. It was directly hurting thousands of people who made their living selling Pampered Chef products. It's a fascinating decision, right? It shows that sometimes even a perfectly principled system can have these awful unintended consequences for people just caught in the middle. He chose to protect the people over the policy.
Okay, so that same exact shareholder as partner philosophy, it's also the engine behind our second case study, Buffett's other great innovation, his absolutely legendary annual letters to shareholders.
This quote just says it all, doesn't it? He wasn't writing for Wall Street analysts or trying to spin some happy story for the media. He was writing to his partners, people he genuinely respected, to give them an honest, unfiltered look at their business. His goal was never to impress anybody. It was only to inform and to educate.
And I mean, look at the difference this makes. On one side, you've got your standard corporate report, right? It's glossy, it's full of confusing jargon, and it's basically designed to make management look awesome. And on the other side, you've got Berkshire's report. Plain text, witty, and brutally honest about mistakes. One is pure marketing, the other is a real conversation between partners.
But what is it that makes these letters so famous? Let's look at some specific examples of the wisdom he packs inside. This is where you can really hear that philosophy come to life in Buffett's one-of-a-kind voice.
That is classic Buffett. With just one simple, unforgettable line, he's doing way more than just being clever. He's actually giving his partners a mental tool to spot conflicts of interest. He's teaching them to think skeptically, to think for themselves, not just about Berkshire, but about any business deal they ever come across.
What a great image that is. He's calling out managers who basically cheat, the ones who change the rules of the game after it's over just to make themselves look like geniuses. For Buffett, it was all about setting clear, honest goals before you start. By sharing this, he's teaching his partners how to tell the difference between real performance and, well, fake success.
And he was never afraid to take shots at the wider business world. Here, he's basically handing his shareholders a crucial diagnostic tool. He's warning them about a massive red flag that applies to any company. When the results start to look bad, you better watch out for managers who try to hide the truth with sketchy accounting. It's another free lesson in what to look for as an owner.
Now this might be the most radical thing he does. It's about being brutally honest about the future. After years and years of incredible growth, he just openly tells his partners, hey, this can't last forever. This isn't just honesty, it's the ultimate sign of respect. It builds an incredible amount of trust because he's treating shareholders like smart adults who can handle the truth about risk. He even turned the annual report into a practical tool for doing business. This business wanted ad published right there in the report
lays out exactly what he's looking for in an acquisition. Clear as day. It's transparent, it's respectful of everyone's time, and it's the ultimate proof of his whole no games, no nonsense approach.
So what on earth does a canceled charity program and a bunch of annual letters have in common? Well, they are two crystal clear expressions of the exact same deeply held belief that shareholders are true partners in the business.
Ultimately, the Buffett philosophy isn't just about making a ton of money. It's a whole system for running the company that's built on fairness, on radical honesty, and on a deep commitment to educating the people who actually own the place. It's about giving them the respect that a real partner deserves.
And we really can't forget the real-world results of all this. That $197 million, that wasn't decided by some corporate committee in Omaha. That was the collective will of thousands of individual owners who were empowered to support the causes that they personally believed in. It really was shareholder democracy in action.
Which brings us right back to that final, complicated choice he had to make. When Buffett protected his people over his policy, was that just a moment of clear-eyed pragmatism? Or does it show us a harder truth, that maybe even the most brilliantly designed shareholder-first ideas are just too fragile when they crash into the messy, unpredictable reality of human conflict? It's a question that really gets to the very heart of what a company's responsibility is.
Thanks so much for joining us for this explainer. We'll catch you on the next one.
Welcome to The Explainer. Today we're cracking open the playbook of, well, one of the most successful minds on the planet. And listen, this isn't just about piling up cash. It's about a single, powerful idea applied relentlessly over a lifetime. Let's dive in.
Okay, you've probably heard this a million times, right? Rule number 1, never lose money. It's his most famous line. But to really get Buffett, you can't just see this as a single rule. It's actually the foundation for two different people, two powerful identities that are always working together, the investor and the businessman.
And it's not just me saying this. His good friend, Carol Loomis from Fortune, she's the one who really nailed it. She said, look, there isn't just one Warren Buffett. There are two. And if you want to understand his masterpiece, Berkshire Hathaway, you have to understand how these two sides of him work together. So let's use a football analogy here. It actually works perfectly. You've got Buffett the investor. He's your star quarterback, the guy who throws those long bombs down the field for huge, game-changing touchdowns. But then you have Buffett the businessman. He's the guy running the ground game, just grinding it out, getting those tough yards play after play. One side is all about those explosive plays. The other is about building a solid, unbreakable lead. Okay, so let's tackle the investor first. You know, his famous philosophy, it didn't just pop into his head one day. Not at all. It was a long journey, a total evolution, really. It started with one powerful mentor, but then it got completely flipped on its head by a lifelong friend and partner. So in the beginning, he was a total disciple of Ben Graham. He learned this super rigid, numbers-only way of finding bargains. He had this great name for them, cigar butts. You know, the idea of finding a discarded cigar on the street that has one last free puff left in it. That's what he was looking for in stocks. But then, 1959 happens. He meets a guy named Charlie Munger, and that meeting sparked a conversation that would last for decades, and honestly, it completely rewired how he thought about investing. And this is the big shift right here. Graham's whole thing was buy a pretty crummy business, you know, like the failing textile mill that Berkshire Hathaway actually was, but get it at an absolutely fantastic price. Munger comes along and says, no, you're thinking about this all wrong. It's way better to buy a wonderful business, something like See's Candies, at just a fair price. Suddenly, the game wasn't just about the numbers on a spreadsheet. It was about the quality and the staying power of the business itself. Now, just because he started listening to Munger didn't mean he stopped looking for deals in strange, unpopular places. Oh no, it just meant he had a new, much more powerful way of looking at the business underneath. And that leads us to, well, one of the gutsiest, most contrarian bets you'll ever see. All right, picture this. It's 1983. There's this entity called the Washington Public Power Supply System. Its nickname? Whoops. I mean, seriously. And the name fit, because the place was a total disaster. They defaulted on billions with a B in bonds for 2 nuclear plants they just gave up on. The market was in an absolute freefall panic. You had lawsuits everywhere, and the big rating agencies like Moody's and S&P, they wanted nothing to do with it, wouldn't even rate the bonds. So while everybody else is running for the hills, what's Buffett doing? He's sitting there, reading the fine print. He did the one thing the panicked market couldn't. He stopped and thought. He realized, wait a minute, The default was on the bonds for the canceled plants. He looked at the bonds for the other plants, the ones that were still up and running. And here's the kicker. They were backed by a federal agency. So where everyone else saw chaos, he saw a secure, government-backed stream of income. He jumped in, big time, and locked in an incredible 16.3% tax-free return.
That whoops deal, I mean, it's the perfect example of his whole philosophy. The best deals aren't the ones everyone is cheering about on TV. They're found in the dark corners, the places that make people uncomfortable, where fear and panic have opened up this huge chasm between what something is selling for and what it's really worth. And that same exact mindset, that rational, go against the crowd thinking, is the key to the other Buffett we talked about, the businessman. The way he runs Berkshire Hathaway, this absolutely massive company, is just as weird and unconventional. He runs it based on a few principles he calls simple, old, and few. Seriously, just throw out everything you think you know about how a big corporation works. At Berkshire, there are no giant all-hands meetings, no 5-year strategic plans sent down from on high. Get this. The entire corporate headquarters for this giant, multi-billion-dollar empire is 11 people. That's it. His philosophy is so simple, it's almost radical. Buy a great business that's run by a great manager, and then, for the love of God, just get out of their way. And you can bet his managers absolutely love it. Take a guy like Ralph Shai. He runs companies you've heard of, like World Book Encyclopedias and Kirby Vacuums. He said that working for Berkshire was actually better than running his own public company. Why? Because he gets just focused on his business. And when he's got extra cash lying around, he just, and this is his phrase, ships the money to Warren. You know, this total hands-off style can be a bit of a shock for new managers. There were these two brothers, the Heldmans, who sold their uniform company to Berkshire. Their old owners used to micromanage every little thing. When they started working with Buffett, they were almost weirded out by how much he just trusted them. No second guessing. They even said, maybe he should do more of that. But that's the whole point. That trust is what lets them do their best work. And this trust, it's really a deep respect for experience. The best story, the one that really shows this, is about Rose Blumkin. She founded the Nebraska Furniture Mart. At 94 years old, she was still running the show. Buffett actually joked in an annual report that he had to convince the board to get rid of Berkshire's mandatory retirement age of 100, because at 94, Mrs. B was, in his words, clearly gathering speed. So, what's the thread that connects both sides of Buffett, the investor and the manager? It's one thing, a single, rock-solid, rational philosophy about value. What value is, how you create it, and, this is key, how you protect it, not just for your shareholders, but for the market in general. You can see this philosophy perfectly in how he thinks about a simple corporate action, the stock buyback. For most people, a buyback is just, a way for a company to give cash back to its investors. Simple. But for Buffett, it's something way, way deeper. He literally calls it a polygraph proxy, a lie detector for management. Think about it. Every CEO says they're working for the shareholders, but talk is cheap. When a company uses its hard-earned cash to buy back its own stock, and this is the important part, only when that stock is trading for less than it's worth, that's the ultimate proof. That's when you know the people in charge are really thinking like owners. And this obsession with real underlying value, it also explains why he was one of the first and loudest critics of pure speculation. We're talking decades before the 2008 financial crisis. He went before Congress way back in 1982 and warned them that things like stock index futures would turn the market into a giant casino. He argued it would distract from what the market is supposed to do, funnel money to good, productive companies. Okay, so we've seen how this rational philosophy applies to business, but what about at home? How does it apply to his own family? Well, his ideas about inheritance might be the most personal, and for a lot of people, the most shocking part of his entire worldview. There's one famous story that just says it all. His daughter, Susan, needed some money to get her kitchen fixed up. He said no. And she's confirmed that people still ask her about this story years later. Now, this wasn't him being cheap. It was a matter of deep principle. He believes that huge, unearned piles of money can actually be a destructive, corrosive force. And he definitely puts his money where his mouth is. He's called leaving massive fortunes to kids antisocial. He thinks it can actually be harmful to them. His whole point is that his kids should have to go out and find their own purpose, build their own lives, not just coast on what he called food stamps for the rich. And this quote, this one sentence just sums up his entire philosophy on life. It's not about being stingy.
It's about calibrating opportunity. He wants to give them a foundation to go out and be ambitious, not a giant cushion that just leads to apathy. It's the ultimate statement of his belief that real value in life comes from what you do, from your own drive, not from who your parents are. So when you look at the whole picture, from seeing value where everyone else saw risk, to managing people with this incredible level of trust, all the way to how he thinks about family and legacy, the entire Buffett playbook really comes down to one single thing: rationality. In a world that runs on hype and panic, being rational is basically a superpower. Which leaves all of us with a pretty tough question to answer, right? The next time you're caught up in a moment of hype or fear, what's the most rational decision you can make?
You know, long before the 2008 financial crisis made too big to fail a household phrase, another Wall Street giant was teetering on the absolute brink, and it threatened to pull the entire global financial system down with it. This is the wild story of how Warren Buffett, an investor famous for his caution, found himself smack in the middle of a massive scandal at Salomon Brothers that almost caused a full-blown catastrophe. So let's get into how this all went down.
And this quote from Buffett himself, it just perfectly sums up his situation. See, he wasn't trying to be some hero looking for an adventure. He was just an investor, a director, who suddenly got yanked out of his seat in the audience and thrown right onto center stage. He was caught in the spotlight of a drama he wanted absolutely no part of. To really understand how Buffett wound up on that stage, we got to rewind the clock a bit, back to 1987. This is where it all starts. Buffett, a man known for his folksy, down-to-earth wisdom, makes a move that just completely shocked the financial world. He decided to partner up with one of the biggest, most aggressive firms on Wall Street. He put a staggering $700 million of Berkshire Hathaway's money into Salomon Inc. Now, at the time, this was his largest single investment ever. And why'd he do it? Well, he was helping Salomon's CEO, a guy named John Gutfreund, fight off a hostile takeover. This was a classic white knight play, where the friendly investor swoops in to save the day from an unwanted buyer. But the deal itself, wow, it was a work of art. Buffett negotiated what he called a dream security. Think of it this way. It gave him a super safe, steady 9% dividend, kind of like a bond. But, and this is the genius part, it also came with what he called a lottery ticket. This was the option to turn his shares into regular common stock if the price took off. It was just a brilliant strategy. Get paid really well to wait for a potential grand slam. And boy, did Wall Street's opinion on this deal change fast. Before the huge market crash in October of '87, everyone was saying Buffett had basically committed banditry, that he totally fleeced a desperate Salomon. But then, after the crash just hammered Salomon's stock, that same deal was suddenly being called a bummer, and you started hearing whispers. Had the Oracle of Omaha finally blown it?
The real irony here is that Buffett was going against his own famous advice. He had always warned people, don't ask your barber if you need a haircut, meaning don't trust investment bankers to give you unbiased advice. But he made an exception for John Gutfreund. He saw him as a man of principle, someone he could personally trust. And that trust, well, it would become the absolute pivot point for this entire story.
Okay, so let's jump forward 4 years to August 1991. Everything's looking great. Salomon's making money, the stock is getting close to Buffett's conversion price, his investment is about to be a massive success. But then, while he's on a ship in Reno of all places, Buffett gets a late-night phone call from John Gutfreund. And that one call was about to change absolutely everything.
So what was the big crime? It was a pretty brazen scheme to manipulate the U.S. Treasury market, one of the most important markets in the world. See, a top trader at Salomon, a guy named Paul Moser, had been systematically breaking the law. The Treasury has a rule that says no single firm can buy more than 35% of the bonds in an auction. It's to stop anyone from cornering the market. Well, Moser just sidestepped that rule by illegally using his clients' names to buy a ton more bonds, then secretly moving them into Salomon's own accounts. It gave the firm legal control of the market. But here's the kicker. The crime itself wasn't even the biggest problem. Nope, it was the cover-up. Top management, including the CEO, John Gutfreund, they were told about this trader's career-threatening actions all the way back in late April. Their own lawyer told them it was probably criminal. And what did they do? For months, nothing. Buffett himself later called this period of just doing nothing inexplicable and inexcusable. And get this, when the whole thing finally blew up, what was management's excuse for sitting on this ticking time bomb for 4 months? You're not going to believe it. The press of other business. Yeah. Buffett's reaction, reportedly, was to call it ridiculous. And I mean, can you blame him? That flimsy excuse was a huge red flag that there was a catastrophic failure of leadership at the very top.
So as the news of the crime and the cover-up starts to spread, confidence in Salomon just evaporates. And for a firm like this, built entirely on credit and trust, losing confidence is a death sentence. The whole institution was starting to crumble fast. Someone had to take the reins.
I mean, just look at how precarious their position was. They had this tiny sliver of their own money, just $4 billion in equity, and it was holding up a mountain of $150 billion in assets. The place was insanely leveraged and completely dependent on credit. Buffett had this great analogy for it. A firm's need for confidence is like our need for air. You don't even notice it's there until it's gone. And for Salomon, the air was running out.
The crisis was hitting a fever pitch. At 6:45 in the morning, Buffett gets a call. Gut friend and his number 2 are resigning, effective immediately. And without even hesitating, feeling this deep sense of duty to all the shareholders, Buffett volunteers to step in as interim chairman. His goal wasn't just about saving his own money anymore, it was about saving the entire company from total collapse.
That night, Buffett goes to meet with the president of the New York Fed, Gerald Corrigan, who is powerful and, let's just say, furious. And in that meeting, he finds out something truly shocking. Salomon's management had gotten a scathing letter from the Fed days earlier, and they'd hidden it from their own board of directors. That deception, Buffett said later, was the atom bomb. It proved to the regulators that Salomon's leadership was just not trustworthy.
Okay, so this brings us to the absolute climax of the story. Sunday, August 18th, 1991. A day that Buffett would later call the most important day of my life. The fate of Salomon Brothers and maybe even the stability of the entire global financial system was hanging by a thread.
At 10 a.m., what one executive called the guided missile hit. The U.S. Treasury publicly announced it was banning Salomon from participating in its auctions. Now you have to understand, this wasn't just a fine or a slap on the wrist, this was a corporate death sentence. The message to the entire world was loud and clear. Treasury to Salomon, drop dead.
So they're all huddled in this crisis meeting, and they're facing 3 and only 3 desperate options. They immediately threw out the idea of lying. They actually started preparing for option 3, bankruptcy, which would have been an absolute logistical nightmare. So that left only one real path forward. Somehow, they had to convince the Treasury to change its mind.
And for Buffett, the stakes were now intensely personal. He'd often told his own kids that it takes a lifetime to build a reputation, but you can destroy it in just 5 minutes. And on that Sunday, staring into the abyss of Salomon's collapse, he really believed he might be living through his own 5 minutes.
So Buffett personally gets on the phone with the Treasury Secretary, Nicholas Brady. And this was not some calm, cool negotiation. Sources say Buffett's voice was actually cracking with emotion as he pleaded his case. He warned him that if Salomon went down, it wouldn't be contained. It would set off a catastrophic domino effect through the whole interconnected global financial system.
For hours, the answer from the Treasury was just a flat no. But Buffett was relentless. He even got Fed President Corrigan to call and intervene for him. And then finally, at 2:30 p.m., just as they were about to hold a press conference to basically announce the firm's death, a breakthrough. The Treasury called back. They wouldn't completely reverse the ban, but they offered what they called half a loaf. Salomon could still bid for its own account. It wasn't everything, but it was the lifeline the firm desperately needed to survive.
So, with the immediate threat of a complete meltdown gone, the long, hard work of cleaning up the firm and rebuilding its shattered reputation could finally begin, with Warren Buffett now officially in charge.
So after all that chaos, how did the investment actually turn out for Buffett financially? Well, it was profitable. The stock he had the option to buy at $38 a share was eventually worth around $81. But Buffett's own grade on the deal tells you the real story. He called it a scratch single after the count got to 0-2. In baseball terms, that means it was a win, but it was an ugly, grueling, near-death battle just to get on base.
And man, did Buffett earn that win. Over the next 9 months, he just methodically cleaned house. He brought in new, credible leadership, he slashed the firm's dangerous leverage, he cooperated completely with regulators, paid a massive $290 million fine, and slowly began to restore Salomon's reputation. And once the job was done, he just went back home to Omaha.
And this right here, this is the most powerful lesson of the whole story. Buffett's warning on that Sunday back in 1991 that a chaotic bankruptcy would trigger a global financial meltdown, It wasn't an exaggeration, it was a prophecy. I mean, it is an absolutely perfect description of exactly what happened 17 years later when Lehman Brothers collapsed and there was no one there to offer even half a loaf. It really makes you wonder, doesn't it? How many other near misses has our financial system survived that we never even heard about?
All right, let's set the scene. Picture a card game happening in Washington, D.C. Now, this is not your average weekly poker night. We're talking about a table where you have absolute titans of American business squaring off against a team of powerful U.S. politicians. It was a high-stakes charity bridge match, sure, but what it ended up revealing about leadership and temperament under pressure, well, that had almost nothing to do with who actually won the game. So here's how we're going to break it all down. First, we'll meet the players. Then we'll get into the match itself. And after that, that's when the real drama begins. We're going to see two completely different leadership styles clash and unpack some pretty powerful lessons that we're hiding in a simple game of cards. Okay, first things first, let's meet the team from the world of business. And, this wasn't just some random group of executives. Nope. This was a powerhouse squad, and they had a name to match. They literally called themselves Team Cash, which stood for Corporate America's Six Honchos. I mean, just look at this lineup. You've got Warren Buffett, the heads of CBS and Forbes magazine, the top two guys from Bear Stearns, plus a heavyweight partner from a major law firm. This was a table with an unbelievable amount of power and influence. So you've got this absolute dream team of financiers and CEOs. Let's get to the match itself, see who they were actually playing against, and, how it all went down. Now, this was all for a good cause. It was a charity event, people paid $100 a ticket, and all the money went to literacy programs. So on paper, it's a friendly game. But make no mistake, with these personalities, the competitive spirit at that table was intense. And in a game like Bridge, which is all about partnership and staying cool, that kind of pressure, it tends to reveal who you really are. And when it was all said and done, well, it wasn't even close. As you can see from the score, Team Cash just walked all over the politicians 54-39. The team's captain, the CEO of CBS, just said everyone played well. A very simple, clean victory. The captain of the losing team, though, Congressman Arlen Stengelland, was, let's just say, a little more direct about how he felt. His summary of the night? It was the pits. You can just feel the sting in that quote, can't you? But here's the thing. The story doesn't end with that lopsided score. Oh no. For one of the players, Bear Stearns president Jimmy Kane, the real high-stakes game started after the cards were put away, when he sat down for an interview with a men's magazine. And he came out absolutely swinging, but not at his opponents. This quote right here is aimed squarely at his own star-studded team. Think about that for a second. This includes Warren Buffett and Alan Greenberg, his own boss at Bear Stearns. Kane was a national champion bridge player, and he clearly wanted everyone to know that these other titans of industry, they just weren't on his level. But wow, he did not stop there. The next comments he made were even more explosive. He basically claimed that women didn't have the emotional stability to be top players or traders, suggesting that when the pressure gets really intense, they just break down. For a company like Bear Stearns, which was already dealing with sex discrimination lawsuits, this was like pouring gasoline on a bonfire. So, as you can imagine, the backlash was immediate and fierce. Kane tried to walk it all back. He sent a letter to all his employees saying the quotes were either made up or twisted. But the writer of the article, Duncan Christie, he wasn't having it. He fired right back, saying everything was on tape and meticulously accurate. Even his own professional bridge coach, a female grandmaster named Judy Radin, seemed to hint at this side of him. While she defended him as a great guy, she also admitted he's just too intense, and that he actually called her before the article came out to warn her she wouldn't like it. So on one side of the table, you've got this super intense, unfiltered executive who's just created a massive PR disaster for himself and his company. It just begs the question, right? What was his billionaire teammate, a man famous for being calm and thoughtful, focused on during this exact same time? So let's pivot to Warren Buffett, because when we look at him, we see a completely different picture of leadership, of focus, of how to play the game of life, really. While Kane was obsessed with the intensity of the moment, Buffett was playing an entirely different game altogether. See, for Buffett, it's not about the raw, competitive win. It's about genuine, deep satisfaction. Just think about the contrast with Kane criticizing his own partners. Buffett says it right here. The absolute key for him is to only work with people he genuinely likes and admires. It's a fundamental choice about who you surround yourself with. And this right here reveals such a fascinating split in how he thinks about problems. When it comes to investing, he's famous for looking for 1-foot bars, the easy, obvious wins that you can just step over. But when it comes to his philanthropy, he does the complete opposite. He actively seeks out the 7-foot bars, the hardest, most complex problems imaginable. And what were these impossibly high bars he was trying to clear? Well, his foundation was focused on 2 massive global challenges: population control and the threat of nuclear war. He called them real Lulus, problems so big you can barely even see the top. His plan for the future, for his legacy, wasn't about controlling everything from beyond the grave. It was built on one simple, powerful idea: trust. His entire philosophy was to find smart, high-grade people, give them the resources, and then get out of the way so they could solve the problems of their own time.
And this patient, long-term thinking is the exact same philosophy at the heart of his investing strategy. He's not rattled by short-term panic. In fact, he sees opportunity when everyone else is running for the exits. It's a thoughtful, deliberate approach, the polar opposite of a hot-headed, impulsive reaction.
Okay, so let's bring this all back to where we started, that card table. When you lay these 2 mindsets, Keynes and Buffett's, right next to each other, what are the real lessons we can pull from this full deck? This table just lays out the contrast so perfectly. You've got Jimmy Kane on one side, intense, impulsive, totally focused on the immediate win, and completely unfiltered. And on the other side, Warren Buffett, deliberate, patient, focused on the long-term vision, and incredibly thoughtful. It's really a clash between raw competitive drive and a kind of collaborative wisdom. So in the end, the bridge match, it was just a stage. It was really the pressure of the game and the spotlight that came after that acted like a magnifying glass. It brought the fundamental character and the totally different leadership styles of these 2 men into sharp, clear focus. That's what we saw: 2 titans and 2 completely different playbooks for how to get to the very top. And that really leaves us with the big question here. In the high-stakes game of business, or even life, what do you think is more valuable in a partner? Is it that intense, unfiltered drive to win at any cost? Or is it the patient, long-term wisdom to see the much, much bigger game being played? Warren Buffett. We all know the name, we know the billions. But do you actually know the playbook? The real methods, the hard-won lessons that actually built the legend. Well, that's what we're going to do today. We're going to decode his framework, we'll look at his biggest mistakes, and we'll try to understand the man behind the money, all using his own words from a really defining time in his career. So let's jump right in. We're kicking things off with this quote from 1993 because it's just a perfect window into how Buffett's mind works. It is pure, it is relentless logic. This is exactly the kind of clear thinking he uses to just slice through all the noise on Wall Street. It's really the foundation of his entire philosophy, and it sets the stage for everything we're about to get into. So here's our game plan. First up, we're going to establish the Buffett benchmark, the standard everyone else is measured against. Then we'll get into his craftsman's code, his core principles. After that, and this is fun, we're going to look at some of his biggest goofs, because you can learn just as much from his mistakes as his wins. Then we'll explore the man behind the money, and we'll wrap up with the incredible ripple effect his success has had on the world. All right, let's dive into Section 1, the Buffett benchmark. For decades, the holy grail in investing wasn't just to beat the market. It was to find the next Warren Buffett. But to really get that, you have to look at the original. So picture this. It's the late 80s, and Buffett's track record is it's absurd. He'd consistently done what most people thought was impossible, compounding money at around 25% a year. Now, compounding is just your earnings making their own earnings. It's like a snowball rolling downhill. But at 25% a year, that's not a snowball, that's an avalanche. So Fortune magazine actually launched a formal search trying to see if they could bottle that lightning and find the next guy. But the original was spotted way, way before any magazine cover. This timeline tells the amazing story of a physics professor named Homer Dodge. Back in 1956, he saw something in this 25-year-old kid from Omaha. Something so special that he drove 1,500 miles and handed this young guy his family's entire life savings. I mean, what a leap of faith. And by the time Dodge passed away, that investment had turned into tens of millions of dollars. Just incredible. So what did Homer Dodge see? What was it? Well, that brings us to our next section, the Craftsman's Code. Let's actually unpack the principles that drive all of his decisions. So what's in the code? Well, this is it, straight from Buffett himself. And notice what's at the top. It's not about being the smartest person in the room. It's about high-grade ethics. It's about putting your own money where your mouth is. But the real key, the absolute game changer, is that last point. He says raw intellect is overrated. What really matters is rationality, that ability to just stay calm and think straight, while everyone else is losing their minds to greed or fear. That, right there, is the superpower. And here is a cornerstone of that whole rational approach. Buffett figured out that a truly fantastic business can get through a massive but temporary storm. And the real opportunity? It comes when the market totally freaks out about that storm and can't see the clear skies that are just ahead. And the salad oil affair is the perfect case study for this. So in 1963, American Express gets slammed by this huge scandal involving one of its subsidiaries. The market panics, the stock gets absolutely crushed. But Buffett, he stays rational. He doesn't just stare at the stock price. He actually does the grunt work. He goes to restaurants, he goes to stores, he talks to merchants and customers. And what does he find? The real businesses, the credit cards and traveler's checks, they were humming along, strong as ever. The brand was fine. So he bet big against all that fear, and he watched his investment grow 5 times over in just 5 years. You know, this simple little story just captures his mindset perfectly. So he has this great ham and cheese sandwich at a deli, and he insists on going back the very next day. His reasoning? Why risk a bad one somewhere else? It's all about predictability, certainty, knowing exactly what you are going to get. And it sounds kind of funny, but that preference for consistency, that's the bedrock of his entire investment philosophy. But look, he wasn't always right, not by a long shot. And you can't really understand a master without studying their mistakes. Which brings us to Section 3, a legend's biggest goofs. Buffett is super open about his errors, and honestly, they contain some of his most powerful lessons. Early in his career, he followed his mentor, Ben Graham, and practiced what he later called the cigar butt approach. The idea is you find this disgusting, discarded cigar butt on the street, a terrible business, but it's so cheap that you can pick it up and get one last free puff of profit out of it. And ironically, his most famous investment ever, buying a dying textile mill called Berkshire Hathaway, was a perfect example of this flawed idea. This slide right here shows the single most important evolution in his entire way of thinking. He learned the hard way to stop buying fair companies at a wonderful price and start buying wonderful companies at a fair price. Why the big change? Because with a mediocre business, a cigar butt, time is your enemy. Every day that goes by, it gets worse. But with a truly great business, time becomes your absolute best friend, letting that magic of compounding do its work. This was a multi-million-dollar lesson that changed everything for him. Okay, this next concept is something Buffett called his most surprising discovery. He started out thinking that if you just got smart, hardworking managers, they'd naturally make rational choices for their companies. But he was dead wrong. He found this kind of invisible force he called the institutional imperative, and it causes entire companies to just mindlessly copy each other and resist change, no matter how dumb it is. And he laid out these 4 classic symptoms. First, the organization just fights any change to what it's already doing. Second, projects and work will magically expand to use up all the money and people available. Third, whatever crazy idea the CEO has, no matter how foolish, will suddenly get backed up by piles of strategic studies. And finally, the most dangerous one, companies will just mindlessly copy what their competitors are doing, even if it's a terrible idea. So, fighting those kinds of forces, it takes a really specific kind of temperament. And that brings us to Section 4, the man behind the money. What's Warren Buffett actually like when the stock market is closed? Let's look at 1990. The market was getting crushed, and Berkshire Hathaway was getting hit even harder. It fell 36%, more than double the S&P 500's drop. On paper, Warren Buffett lost something like $1.5 billion of his own money. Just think about that for a second. How would you be feeling? This was his response. No panic, no screaming phone calls, just this simple, totally unbothered statement. It's the perfect illustration of his emotional stability. See, he doesn't care about the market's daily mood. He cares about the long-term health of the businesses he owns. The stock price is just noise. The real value is what that business is going to earn for years and years to come. But that legendary focus could cast a really long shadow. His son, Howard, has talked about the huge pressure of growing up as a Buffett. He said he felt like he couldn't even try something simple like a lemonade stand, because how could it ever measure up to what his dad was doing? And this might be the most Buffett story of all time. So he owned the farmland that his son Howard worked, and he charged him rent. But get this, the rent was a percentage of the farm's income, and the percentage was tied to Howard's body weight. If Howard kept his weight down, he paid 22%. If it went up, the rent jumped to 26%. I mean, it is just this perfect, unforgettable mix of business logic, fatherly concern, and, as his son said, this deep impulse to always control all the variables. All that incredible success, though, it created way more than just personal wealth. So for our final section, we're going to explore what we're calling the ripple effect, how the value that Berkshire generated created this quiet but really powerful wave of philanthropy. This table shows an incredible and often totally overlooked part of the whole Berkshire story. The massive fortunes that were created didn't just stay with Buffett. So many of his earliest partners, the Offmers, the Hellsbergs, the Scotts, they became huge philanthropists in their own right, using the wealth they earned to build hospitals, universities, and concert halls. And that right there is the key takeaway. Long before Buffett made his own historic promises to charity, the wealth machine he built was already changing communities for the better. This ripple effect meant that his genius for compounding money was also, in a way, compounding good in the world, all through the hands of the partners who trusted him from the very beginning. So we'll end on this. In that same article where he laid out all his mistakes, Buffett promised he'd write a follow-up in 25 years. And that commitment, that dedication to always be learning, might just be his greatest lesson of all. It leaves us with a final question to think about. What new goofs, what new discoveries did the Oracle of Omaha make in the decades that followed? And what can we learn from them today?
Today, we are diving deep into one of the most legendary investments of all time. Seriously, it's a story packed with conviction, some major boardroom power plays, and of course, a truly staggering long-term payoff. We're talking about Warren Buffett's billion-dollar bet on Coca-Cola, a total masterclass in how he sees value, risk, and what it means to be way more than just a passive shareholder. So, let's get into it.
All right, so we're going to break this story down into 5 parts. First, we'll look at the absolutely audacious initial investment. Then we'll explore the simple genius behind Buffett's whole idea. After that, we get into the real drama, the boardroom stuff where Buffett had to flex his muscle. Then we'll unpack the core philosophy that drove all his decisions. And finally, the best part, the incredible, mind-blowing financial results.
So, where does a story like this even begin? Well, not in some booming market, not when everyone's feeling great. Nope. It starts in the wreckage of a massive crash. This was not a fair-weather investment. This was a calculated, gutsy move made when fear was completely running the show.
You've probably heard this quote a million times, right? Well, this is Buffett actually living it. The 1987 market crash absolutely hammered Coca-Cola's stock, just like it did with pretty much everything else. But you know, where most people saw nothing but red and felt nothing but panic, Buffett saw something totally different. He saw world-class business on a massive discount.
So Buffett starts buying, and he's buying so much that people start to notice. Coke's own president, a guy named Donald Q, who happened to be a good friend of Buffett's, sees this huge block of shares being bought up, and he has a hunch. So he picks up the phone, calls Warren, and asks him straight up. And Buffett just says, well, keep it quiet, but yep, it's me.
What's amazing when you look at this timeline is the incredible patience. I mean, this wasn't a quick trade. He started buying in '88, joined the board a year later, and was still accumulating shares. It wasn't until 1994, a full 7 years after the crash, that Berkshire finally had its full position. It was just a slow, methodical, and supremely confident process.
And here's the final number. The total cost, $1.3 billion. Now that's an enormous sum for anybody, even for Buffett, to acquire what would become 400 million shares. This wasn't just another stock in the portfolio. This was a defining, table-pounding bet on the future of one single company.
So what on earth gave him that kind of conviction to bet the farm? Why Coca-Cola specifically? Let's get into the simple, almost beautiful reasoning behind what he saw as just an unshakable business.
This quote right here, it really sums up the whole thing. For Buffett, the logic was just plain undeniable. You had a product that sold for a pretty cheap price, was loved pretty much everywhere, and people just drank more of it year after year in almost every country on the planet. In his words, there was simply no other product like it. But it wasn't just about the product. It was also about the people running the show. He famously called the leadership duo of CEO Roberto Guita and President Donald Koo the 1927 Yankees, a nod to one of the greatest baseball teams ever. It was a total dream team. Now contrast that with how he later saw their successor, Douglas Ivester, who he felt was more like a bat boy at the plate. So yeah, management mattered. A lot.
And this quote, wow. This just brilliantly illustrates his belief in the company's moat, its competitive advantage. He was convinced that the brand and its global reach were so dominant, so baked into the culture of the entire world, that you could have all the money on earth and you still couldn't replicate it. To him, it was basically invincible.
For years, this investment was a dream come true. But then, the 1927 Yankees era came to an end, and our story takes a really dramatic turn. All of a sudden, Buffett's role had to change from this happy, long-term investor to an active director who felt he had to step in to protect his investment.
Okay, so here's the sequence of events that sparked the whole crisis. After the legendary CEO Roberto Guizueta passed away in '97, Douglas Ivester took over. Now, following a legend is never easy, and his 2-year run was, well, let's just call it unhappy. It was plagued with setbacks that really shook the market's confidence, and it all came to a head over a few critical days in December of 1999.
So what actually went down? Get this, Ivester flies to Chicago for what's supposed to be a routine meeting. But while he's there, he gets called into a private meeting with Buffett and another director, Herbert Allen. Now, these two were known as the board's 800-pound gorillas. Together, they calmly but very firmly told Ivester that they had lost confidence in his leadership. There was no shouting, no big confrontation, but the message was crystal clear, and it was irreversible. Ivester flew back home, and just 4 days later, he quit.
I mean, that was a stunning display of boardroom power, right? But it wasn't the last time Buffett would have to step in. To really get why he did what he did, we need to understand the fundamental principles that guide him, especially how he thinks about value, and more importantly, risk.
All right, so the next big test came pretty quickly. The new CEO, Doug Daft, came in with a huge proposal, a nearly $16 billion all-stock deal to buy Quaker Oats, mainly for its Gatorade brand. Now, Buffett wasn't against the idea of buying things, but he was dead set against the price. He argued that paying with Coke's super valuable stock meant giving up over 10% of the world's best business for assets that, in his view, just weren't worth that much. After a marathon 5-hour board meeting where Buffett laid out his case, the deal was off.
These actions, getting a CEO ousted, killing a massive merger, they seem pretty risky from the outside. But it kind of begs the question, how does Warren Buffett himself even define risk? I can guarantee you his definition is way different from what you'd find in a finance textbook.
Okay, this is the crucial difference. In academia, they define risk with this thing called beta, which is basically just a fancy word for how much a stock price bounces around. By that logic, if a stock price plummets, it's suddenly riskier. Buffett thinks that's completely nuts. For him, risk has nothing to do with a price on a screen. Risk is the real-world possibility of permanent damage to the actual business. A price drop isn't risk, that's opportunity. The real risk is owning a crappy business, plain and simple.
Of course, not every investment is a home run like Coca-Cola, and Buffett is always the first to admit his mistakes. He even has this great joke about one of his most infamous investments, US Air. It just goes to show you that his focus on business quality comes from some pretty hard-won experience.
He put $358 million into US Air preferred stock, and for a while it looked like a total disaster. But because of how he structured the deal and a miraculous turnaround by a new CEO, Berkshire actually walked away with a pretty hefty profit. But here's the kicker. The underlying business, US Air, later went bankrupt. Twice. It proves his point perfectly. The real risk was always in the fragile airline business itself, not in the temporary price swings of his investment. And that brings us to our final act. After all the drama, the incredible patience, and that unwavering conviction, what was the ultimate result? What was the final score on Buffett's billion-dollar bet on Coca-Cola? The numbers are, well, they're just staggering. The initial cost, all in by 1994, was around $1.3 billion. Fast forward to mid-2012, and that very same stake was worth $15.6 billion. Just an absolutely incredible return, all driven by the growth of the business itself.
And when you see it on a chart like this, it really just drives the point home. That small bar on the left, that's the entire cost. That towering bar on the right, that's what it turned into. That right there is the power of compounding when you combine it with an absolutely elite business.
And here's one final brilliant little detail. Because Coca-Cola was constantly buying back its own stock over the years, Berkshire's ownership stake actually grew. It went from 7.8% to 8.9% of the entire company, and they didn't have to spend another penny. Their slice of the pie just got bigger, basically for free. So the story of Buffett and Coke is so much more than just a great stock pick. It's a real lesson in identifying quality, in understanding what risk truly means, and in having the courage to act when you need to. And it kind of leaves us with a big question to think about. What are those timeless principles that make a business truly great? And how can we get better at spotting them ourselves?
All right, today we are diving into one of the most fascinating and, frankly, unexpected friendships in modern history, the alliance between Warren Buffett and Bill Gates. Now, on the surface, these two couldn't be more different, right? You've got the master of old-school industry and super patient investing. And then you have the titan who literally wrote the code for our digital age. So the big question is, how on earth do these two giants, from completely opposite ends of the business universe, become not just friends, but truly trusted partners?
You know, Warren Buffett himself said it best. He looked at their friendship and was like, we're sort of the odd couple, aren't we? And it's that exact odd couple dynamic that makes their story so amazing. It's a pairing that, if you just saw it on paper, would make absolutely zero sense. And yet, it forged this incredible bond that went on to influence business, philanthropy, and honestly, the lives of millions of people. So here's how we're going to break down this incredible story. First, we'll dig into just how different their worlds really were. Then, we'll look at their totally unique philosophies for building wealth. After that, we'll uncover the surprisingly similar playbook they were both secretly using. We'll wrap up with some amazing lessons from a rare public talk they gave together and explore the unbelievable legacy they're building.
Okay, let's just start with how improbable this whole friendship even was. I mean, you have the ultimate industrial age investor, a guy who built his fortune on things you can touch, on predictable, stable businesses. And he meets the architect of the information age, a guy who made billions selling, as he called it, pure thought stuff. I mean, just look at these contrasts. They are absolutely wild. Back in the mid-90s, you've got Buffett, he's 64, a self-proclaimed technophobe who jokingly called his private jet the indefensible. And then there's Gates, 25 years younger, the ultimate technologist who shows up to their very first meeting in a helicopter. Buffett's world was Coca-Cola and Gillette razors, simple, easy to understand products. Gates's world? It was software, incredibly complex, constantly changing, and completely intangible. You really couldn't find two people who were more polar opposites.
And that brings us to the day they first met, which, by the way, almost didn't happen. Get this, Gates was so skeptical, he told his mom he was only going to stay for 2 hours tops. He was thinking, what are we even going to talk about? P/E ratios? But the second they started talking, something just clicked. Buffett began firing off these brilliant, razor-sharp questions about IBM's business model, about the future of newspapers, and Gates was just floored by his clarity of thought. That 2-hour visit he'd planned, it turned into the entire day. And just like that, a lifelong friendship was born.
So you've got these two guys who see the world through completely different lenses. It's no surprise, then, that their playbooks for building wealth look just as different. So let's actually break down their core philosophies, because this is where it gets really interesting. Okay, so Buffett's strategy is famous for its almost beautiful simplicity. It's all built on one thing: predictability. First, you buy companies at a price so good you're practically guaranteed not to lose money. Second, he invests in businesses that are so straightforward that, as he famously said, even a fool can run them. Third, he is unbelievably patient. He's not swinging at every pitch. He's happy to just wait for that one perfect fat pitch right down the middle. And the golden rule through all of this? Stay in your lane. If you don't understand fast-moving tech, you just don't go there. Period. And then you have Bill Gates's world, the absolute total opposite of predictable. His arena is all about constant chaos and revolution. He knew better than anyone that even a giant like IBM could get complacent and miss the next big thing. He didn't run from a crisis, he actually used it as a tool. When the internet threatened Microsoft, he deliberately created a sense of crisis inside the company to force everyone to pivot fast. And he was always thinking globally. Take China. He famously said that if people were going to pirate software, he wanted them to pirate Microsoft's because he was betting they'd get hooked and eventually they'd pay up. What a mindset.
All right, so on one hand, you have the master of predictability. On the other, the king of chaos. It seems impossible that these two would have anything in common, but this is where their story gets truly mind-blowing. Because underneath all those differences, they were both operating from a surprisingly similar set of core principles.
And this really is the key question, isn't it? With completely different industries, different strategies, even different personalities, what was the common thread? What was the secret ingredient that held this odd couple together and made their friendship so powerful?
Well, it turns out the whole thing was built on 4 powerful pillars. First, a radical, almost obsessive commitment to being rational. As Buffett puts it, it's not about having a 400 horsepower brain, it's about getting all 400 horsepower of output from it. Second, an incredible, almost ruthless focus. These guys are masters of saying no to distractions. Buffett literally keeps his calendar empty so he has time to just sit and think. Third, a deep, insatiable hunger to learn more. And finally, and maybe this is the most important one, a genuine, infectious love for the game they were playing.
This quote from Buffett just captures it perfectly. He's not just grinding it out for the money. He's doing it because it's just so much fun for him. I tap dance to work. Seriously, how many of us can say that? For him, this isn't a job. It's his passion, it's his art, it's his playground.
And just listen to how perfectly Gates mirrors that exact sentiment. You've got to enjoy what you do every day. For him, that joy comes from battling new problems alongside brilliant people. So here's the key takeaway. Even though they worked in totally different fields, their core definition of a successful life was identical, finding joy and intellectual stimulation in their day-to-day work. So, back in 1998, they sat down together at the University of Washington for this really rare public Q&A session, and the wisdom they dropped that day was just pure gold. It gives us a direct window into their shared mindset.
Buffett offered this incredible piece of advice. He told the students to pick a person they really admire and write down their best qualities. Then do the same for a person they don't admire so much. His point was that you can consciously choose to adopt good habits. And at first, those habits feel light, almost like nothing. But over time, they get heavier and heavier until they become a part of who you are. By the time you're older, those chains are unbreakable. It's just such a powerful reminder that the small choices we make every single day are literally building the person we are going to become. And when they were asked about their best decisions, their answers were, again, so revealing. For Gates, it was all about the people, choosing to partner with Paul Allen, and later bringing on Steve Ballmer. He said it's crucial to have someone you trust completely who can also call you out on your bad ideas. Buffett's answer was way simpler. His best decision was just getting started, jumping in the pool. He always stresses that you don't need 50 great ideas in your life. You just need a few really obvious ones that you actually act on.
Even how they think about failure highlights their different worlds. Buffett's biggest regrets are what he calls mistakes of omission, the great investments he completely understood but then just failed to pull the trigger on. He also calls buying Berkshire Hathaway itself, which was a cheap but failing textile mill, a used cigar butt mistake. Gates, on the other hand, lives in a world where you have to make mistakes and course-correct constantly. He fully expects to face huge existential crises every single decade, and openly admits he completely misjudged the internet at first, which forced a massive public pivot for Microsoft.
And all of this brings us to their ultimate shared principle: what you do with the insane fortunes you've built. And here, their philosophies don't just align, they are virtually identical. They're centered on luck, on gratitude, and on a really profound sense of responsibility to the rest of the world.
At the very heart of their philanthropy is this powerful idea they call the ovarian lottery. Both of these men feel incredibly lucky. They recognize that their specific talents just happen to be super valuable in the society they were born into. As Buffett once said, if he'd been born in a different time, he might have ended up as some animal's lunch. They don't see their success as some divine right. They see it as winning a lottery they never even bought a ticket for.
And Buffett uses this brilliant thought experiment to explain it. Imagine a genie shows up 24 hours before you're born and says, you get to design the world you're about to enter. But here's the catch. You don't know who you're going to be. Rich, poor, smart, not so smart, male, female. You're just one random ball in a barrel of billions. What kind of world would you design? Well, you'd want a system that rewards talent, sure, but you'd also want a massive safety net for those who just got unlucky. And that idea right there is the moral bedrock of their philanthropy.
This philosophy even extends to their own families. This famous quote just says it all, doesn't it? They both see massive inherited wealth as a kind of poison, not just for their kids, but for society as a whole. They want to empower their children, not paralyze them with so much money they have no reason to do anything meaningful with their lives.
So what does this all add up to in the end? A commitment that is just staggering. Both men have pledged to give away over 99% of their fortunes. That's a number that speaks way louder than any words ever could. It's a testament to their shared belief that their wealth is ultimately a resource that belongs back in the hands of society.
And so we end right back where we started. An odd couple for sure. One built an empire on predictability, the other thrived in chaos. But their friendship, their incredible success, and their lasting legacy were all built on the same bedrock of shared values: rationality, intense focus, a love of learning, and a profound sense of duty. Their story really leaves us with a final thought. What are the true universal principles that underpin not just a successful business, but a successful and meaningful life?
All right, let's talk about a legend, Warren Buffett. You know his company, Berkshire Hathaway, is one of the most admired on the planet. But here's the thing, what does it actually do?
And that's a totally fair question, right? I mean, you can probably explain what Apple does, or Amazon, or Google. But Berkshire Hathaway? Most of us kind of get to, oh, that's Warren Buffett's company. And then, well, it gets a little fuzzy. It's this wild, incredibly profitable mix of insurance, a whole bunch of other random businesses, and of course, one of the greatest investors of all time pulling the strings.
And that right there is the key. The secret sauce behind Berkshire isn't some complex corporate flowchart. Nope, it's a direct reflection of how Warren Buffett thinks. So if we want to understand this incredible value machine, we have to get inside his head and see how he looks at business, the markets, and yeah, even risk.
Okay, so let's start with the blueprint. Now, most people think of Buffett as this master stock picker, and he is, but his real love, the absolute engine of Berkshire's growth, is buying entire businesses, lock, stock, and barrel.
This really gets at a huge difference in mindset. Think about it. When you buy a stock, you own a tiny slice, right? The profits are kind of over there. Berkshire has to get hit with taxes on dividends or capital gains to even touch that money. But when they own a company completely, like See's Candies, every single dollar of profit flows directly to them. And you know, it's not just about the money. For Buffett, it's also personal. He just loves owning and helping to build real businesses with managers he truly trusts.
So, what's on his checklist? You might think it's some crazy, complex algorithm, but it's not. It's actually shockingly simple. First, he needs to understand the business. It can't be something that's changing super fast or is unpredictable. That's why he stayed away from tech for so many years, right? He looks for honest, talented managers, a price that makes sense, and, this is key, a business that just spits out cash. And get this, he doesn't even care if the earnings are perfectly steady. He's famously said he'd take a lumpy 15% return over a smooth 12% any day of the week.
But look, even with these solid principles, he's human. He's not perfect. And to really understand how he thinks, you've got to look at his mistakes. And boy, did he have a big one. Dexter Shoe. This quote here just perfectly captures how blunt and honest he is about his own screw-ups, which, you know, is a huge lesson all on its own.
See, the problem with Dexter wasn't just that he bought it. The real disaster was how he bought it. He paid for it using Berkshire Hathaway stock, and he completely whiffed on the threat from cheap overseas competition. So as Dexter's value just went up in smoke, the Berkshire stock he traded for it, well, that skyrocketed in value. He made a bad deal 1,000 times worse. He basically traded diamonds for dust. He admitted later he way overpaid, but said paying with his own valuable stock was the truly catastrophic mistake.
All right, let's zoom out a bit. We've talked about how he buys companies, but what about his view of the stock market as a whole? He has this really unique long-term way of looking at it that's totally at odds with Wall Street's obsession with the next quarter. He sees the market as this weird machine with its own kind of logic.
Okay, this is where things get really interesting. Check out these two 17-year chunks of time. From 64 to 81, the Dow basically went nowhere, up 0.1%, flat as a pancake. But then, from 81 to 98, it went berserk, up almost 950%. Now here's the kicker. The US economy, the GNP, actually grew faster during that first flat period. So what gives? If it's not the economy, what on earth is driving the market?
Well, Buffett says it all boils down to two things. The first one is what he brilliantly calls the gravity of the financial world. interest rates. It's such a great metaphor, right? Just like physical gravity, even a small change in interest rates affects the value of everything. So in that first flat period, interest rates were soaring, pulling all the asset values down to earth. And in the second boom period, rates plummeted, and everything just floated up.
The second thing, it's all in our heads. It's psychological. It's the same mistake investors make again and again and again. We're always looking in the rearview mirror. If the market's been hot, we assume it'll stay hot. If it's been tanking, we get scared and think it'll never recover. And this rearview mirror thinking is what causes these huge, totally irrational swings in the market.
And this chart just drives that point home. See those bars? That's the growth of the U.S. economy per person, decade after decade. It's a story of pretty darn consistent progress, right? A steady climb. But the stock market over that same period? Whoa! It was all over the place, lurching from massive booms to long, painful slumps. The actual value of the country was growing steadily, but how investors felt about that value? That swung back and forth like a pendulum.
So what's the big takeaway here? It comes down to this classic analogy from Buffett's own teacher, the great Ben Graham. He said that in the short run, the market is a voting machine. It's a popularity contest, driven by fear and greed. But in the long run, it's a weighing machine. And eventually, substance always wins. The actual real value of the businesses is what gets weighed, and that's what truly matters in the end.
So how does he personally weigh the market? Well, he has this go-to tool, a simple ratio that everyone now calls the Buffett indicator. What you're seeing here is a chart of that indicator. It just takes the total value of all stocks and compares it to the country's total economic output, the GNP. He's called it the best single measure for figuring out if the market is cheap or expensive. When that line is down low, say around 70 or 80%, he thinks it's probably a good time to buy. But when it shoots up towards 200%, like it did back in the dot-com bubble, he says you're basically playing with fire.
Okay, so we've seen Buffett, the optimist, the believer in American business, but he's also a stone-cold realist when it comes to danger. And years, I mean years before the 2008 financial crisis blew everything up, he was sounding the alarm about a very specific threat hiding in plain sight.
He called them financial weapons of mass destruction. Just let that sink in. He saw these things as ticking time bombs, not just for the banks playing with them, but for the entire economy. I mean, talk about a scary and accurate prediction.
So what exactly are derivatives? Well, put simply, they're just financial contracts that get their value from something else. It could be an interest rate, a stock price, the price of oil, you name it. As Buffett says, the only limit is the imagination of man. Or, he jokes, madmen. The real danger is that they're so complex, and they allow massive amounts of risk to be hidden away and concentrated in just a few spots.
And this is the daisy chain risk he was so worried about. Imagine a company thinks it's safe. It's spread its risk out across a dozen other firms. Looks good on paper, right? But what happens in a real crisis? All those other firms might get into trouble at the exact same time. It's like a line of dominoes. One falls and it starts a chain reaction that can topple the whole system. Suddenly, even healthy companies can get dragged down by the failures of their partners. Okay, let's step back from all that risk and talk about the fortress that Buffett actually built, Berkshire Hathaway. Because the way he manages the company is just as unique as the way he invests. The whole Berkshire model is really built on two things: trust and freedom. He famously says, "We don't have any MBAs running around telling these people what to do." His philosophy is simple: buy a great business that's run by great people, promise them you'll leave them alone, and then actually leave them alone. Their only job is to run their business well and send the extra cash back to headquarters in Omaha. From there, Buffett and his team figure out the best place to put that money to work next. And this quote right here, it just says it all. I mean, it's just common sense, isn't it? You don't hire a baseball player who's hitting .400 and then immediately start messing with his batting stance. A huge part of Buffett's genius isn't just picking the winners. It's having the wisdom to let them keep doing what made them winners in the first place. Of course, there's always the elephant in the room, right? What happens when Buffett's no longer around? Well, he thought about that for a long, long time. He knew that nobody could possibly do his job alone, so he came up with a plan to split the role. His son, Howard, will step in as non-executive chairman, his main job being to protect the company's unique culture. And the really critical jobs, like investing all that money and managing the actual businesses, will be handled by other top executives who've already proven themselves inside Berkshire. When you boil it all down, everything we've talked about today really comes back to this one core idea. Buffett isn't trying to get rich quick.
He's not chasing the latest fad or trying to time the market. He is just patiently, rationally, brick by brick, building a financial fortress, one that's designed to last and thrive for decades, long after he's gone.
And that kind of leaves us with one last big question to chew on. Buffett's entire empire is built on patience and thinking long-term. But we live in a world of high-speed trading, of instant everything. So does that slow and steady approach still work? Is patience still the ultimate superpower in today's world? It's definitely something to think about. Thanks for joining me for this one.
Today, we're going to peel back the layers on one of the most fascinating minds in finance, the one and only Warren Buffett. But here's the twist. We're not looking at his entire life. We're zooming in on a really specific and honestly a pivotal window of time, 2003 to 2006. Using his own words, pulled from some incredible Fortune magazine articles from that era, we're going to build a picture of his entire worldview, how he saw the economy, philanthropy, and the very act of investing. So, back in 2003, Fortune magazine used this simple but really powerful line to describe one man. Not a president, not a general, a businessman from Omaha. It suggests this kind of complete, almost unbeatable power. So, who were they talking about, and what did they really mean? Well, that's the question that kicks off our whole story today. To really get how he held that kind of power, we're going to walk through 5 key stories from this period. First up, we'll look at his public status as capitalism's unofficial Lord Protector. Then we'll dive into a brilliant economic story he told called A Tale of Two Islands, followed by his warning for all investors, the Gottschalk family's folly. After that, we get to be a fly on the wall for a remarkable 91 billion conversation with Bill Gates. And finally, we'll peek inside the Oracle's inner circle to understand his most important partnership. Okay, so let's tackle that first big claim. In 2003, Fortune didn't just say Buffett was great. They literally put him at #1 on their list of the most powerful people in business. And the reason why they chose him over all the other titans of industry, well, that's what's so revealing. Now, this is where it gets really interesting. The magazine looked at Lee Scott, the CEO of Walmart, the biggest company on the planet. They also looked at Bill Gates, the richest man in the world, with his massive war chest at Microsoft. But here's their logic. Scott, they figured, could be replaced, and Gates's power was often just potential, not something he was always using. Buffett's power, it was totally different. They called it moral suggestion. Basically, he had the complete admiration of a whole generation of business leaders. His words, just his words alone, could change how people behaved, way beyond the companies he actually owned. And this right here just shows how far that influence went. His yearly letter to Berkshire Hathaway shareholders wasn't some boring corporate document. It was a global event. It was so respected that when Bill Gates was trying to explain the American stock market to the president of China at the time, Jiang Zemin, he basically said, look, there's only one guy who truly gets it, Warren Buffett. And then he mailed him a copy. I mean, that's a level of influence that is just way beyond a balance sheet. So with all that power and influence, what was actually on Buffett's mind back in 2003? Well, one of his biggest worries was the growing U.S. trade deficit. And to explain this huge, complicated economic problem to regular people, he did what he does best. He created a simple, powerful story. He called it The Tale of Squanderville and Thriftville. Okay, so let's walk through this. Picture 2 islands. At first, everything's cool. They both produce what they need. But then, the hardworking folks on Thriftville start working double time, and they start shipping all their extra food over to Squanderville. The people on Squanderville love this. They get to eat without working. But how do they pay for it? Not with stuff they make, but with IOUs. Buffett called them squander bonds. Pretty soon, Thriftville is sitting on a giant pile of these IOUs, and they're starting to get a little nervous. So they cash them in. Not for cash, but for the only real thing Squanderville has. It's land. And you can see where this is going. Eventually, Thriftville owns all of Squanderville. And now, the squanders not only have to go back to work just to eat, they have to work even harder to pay rent to the people who now own their entire island. It's a chilling warning about trading your actual assets for stuff you just consume. And look, Buffett wasn't just telling a little bedtime story. He was sounding a massive alarm because in his eyes, in 2003, the U.S. was Squanderville. The trade deficit, that's the gap between what we import and what we export, had hit a mind-boggling $500 billion. We were, as he saw it, selling off pieces of our country's farm to pay for our groceries. But Buffett wasn't a guy who just pointed out problems. He tried to come up with solutions. His big idea was something called import certificates. Basically, it meant that for every dollar of stuff you wanted to bring into the US, you'd have to buy a certificate from someone who had exported a dollar of stuff out of the US. It was a pretty creative way to use the market to force the trade numbers to balance out. Now, it never really went anywhere, but it just goes to show how he thought about solving these enormous national-level problems. Now, Buffett didn't just use these simple fables to explain the whole global economy, he used them to warn regular investors too. And this brings us to his next great story from this time, about a very rich family he called the Gottrocks, and their big mistake of trying to be way too smart for their own good. He boiled his entire investment philosophy down to this just brilliant line, inspired by physics. He called it his fourth law of motion. The more you trade, the more you move your money around, the less you are going to make. It's a direct shot at the constant activity that Wall Street is always trying to sell you. So why does all that motion hurt your returns? Well, because of what he called the army of helpers. First, you've got your broker helpers, and they take a commission on every single trade. Then, when the family realizes they aren't great at picking stocks, they hire manager helpers who charge a nice fee. And when that doesn't work, they hire consultant helpers to help them pick the managers. And finally, you get the hyper helpers, the hedge funds, who show up promising magic for absolutely enormous fees. You see the pattern? Each new layer of help just siphons more and more money away from the actual owners. And the price tag for all of this help is just staggering. Buffett estimated that these, what he called frictional costs, could be eating up as much as 20% of all the money earned by American businesses. I mean, think about that. 1/5 of the entire pie is just gone. Not because the businesses did poorly, but because the owners paid a whole army of people to shuffle paper. The money goes to the helpers, not the Gottrocks. But here is what makes Buffett so compelling. He's brutally honest about his own mistakes. He said his biggest blunders weren't the bad investments he made, but the great investments he failed to make. He actually admitted to missing out on as much as $10 billion in profits from deals he understood perfectly well, but for some reason just didn't pull the trigger on. His words were, "I was sucking my thumb when I should have been writing checks." What an incredible dose of humility. So this brings us to a more personal, more philosophical side of Buffett. In 2005, he sat down with his good friend Bill Gates for a public talk at the University of Nebraska. Just think about this. Their combined net worth at the time was $91 billion. In their conversation, it revealed a huge shift in Buffett's thinking. Okay, first, let's just have some fun and ground these two icons in reality. The best book he'd read recently, Katharine Graham's autobiography. His last big personal splurge? A private jet, of course, a G4 from NetJets, a company he owned. His prediction for the stock market? He said returns would probably be under 10% a year for the next 7 years. And his go-to treat at Dairy Queen? A Blizzard. It's just a good reminder that behind all those billions, they're still just people. But then, he dropped a bombshell. For decades, Buffett's plan was always that his wife Susie would give away his fortune after he died. But after she sadly passed away in 2004, his thinking started to change. And with this one sentence, he signaled a massive shift in his life's plan. This was the very first public hint that he was about to become the biggest philanthropist in history, not after he was gone, but during his own lifetime. He also talked really forcefully about why he wasn't leaving his massive fortune to his kids. He basically thought the whole idea of creating a dynasty of wealth was un-American. And he used this incredibly provocative line, saying that giving your kids a huge inheritance right out of the gate was like giving them a lifetime supply of food stamps, because it just destroys their motivation and goes against the whole idea of equal opportunity. And he was not afraid to get political, especially about taxes. He argued strongly against a flat tax, saying the system was already way too flat. He pointed out the total absurdity that his own tax rate, because of how investments are taxed, was often lower than the tax rate of the people who worked for him. He was really blunt about it. The tax code had been changed to give a huge benefit to the very rich, and that included himself. You just can't understand Warren Buffett without understanding the other half of the equation, his partner and vice chairman at Berkshire Hathaway, the legendary Charlie Munger. Their relationship is the intellectual engine room of the whole operation. Some writer came up with the absolute perfect analogy to describe their dynamic: the Rolling Stones. Buffett is Mick Jagger. He's the front man, the storyteller, the public face. He'll answer a question for 5 minutes with a great story. Then he'll turn to Munger and say, "Charlie?" And Munger, like Keith Richards, just lays down this sharp, unforgettable riff. He'll either deliver a brutally honest one-liner that cuts right to the heart of the matter, or sometimes, just as powerfully, he'll just say, "I have nothing to say." And this quote right here from Munger, this perfectly captures their entire shared philosophy. It's not just about being smart or being clever. For them, being rational isn't just a tool, it's a moral obligation. It is the absolute bedrock of every single decision they make, whether they're buying a company or just looking at the economy. So when you step back and look at this really short period, from '03 to '06, you see this incredible story unfolding. In 2003, he's named the most powerful man in business, and he's using that power to warn everyone about huge economic problems. Fast forward to 2005, and he's totally changing his life's plan for his fortune. And then by 2006, he's acting on the very global trends he saw coming, and Berkshire makes its first ever major foreign acquisition, buying a company called cigar for $4 billion. Which really leaves us with a final big question. Buffett's core advice, especially from the story of the Gottrocks family, was to stop moving, to ignore all the noise and just own good businesses for the long term. But today, we live in this frantic world of crypto and meme stocks and trading bots driven by AI. So is his philosophy of patient, rational ownership more important now than it has ever been? Or is it maybe just a charming relic from a totally different era? That's definitely something to think about.
Welcome to our Explainer. Today, we're diving deep into a decision that absolutely sent shockwaves through the world of philanthropy. Now, this is a story about a staggering amount of money for sure, but it's really about a fundamental shift in how we think about wealth, about legacy, and what it actually means to give back.
So here's what we've got lined up. We're going to start by unraveling the secret behind a truly game-changing announcement. Then, we'll dig into the very personal philosophy that drove the whole thing. We'll even get a look inside Buffett's mind during the chaos of a financial crisis. From there, we'll check out a famous million-dollar bet that put his principles to the ultimate test, and we'll wrap it all up with the playbook that's guided him through investing and, well, life.
Brace yourself. Can you imagine, with just those two simple words, said over a cherry Coke, Warren Buffett was getting ready to completely upend what the world thought it knew about his plans. This wasn't just another deal. No, this was something deeply personal that would reshape the very future of philanthropy.
All right, let's pull back the curtain on this plan. It was so secret, that even the journalists who were there to report on it were pretty much in the dark. The mission was simple, but the stakes, they were absolutely enormous. How in the world do you announce the giveaway of one of history's largest fortunes without the story leaking out first?
I mean, just try to wrap your head around that number, $37 billion. At the time, that was more than the GDP of a lot of countries. Buffett wasn't just chipping in a bit of his wealth. He was committing the vast majority of it, 85% of his stock, to charity. It was a move that was just unprecedented in its scale. And look, this wasn't just him writing a big check and calling it a day. No, this was a carefully crafted plan. It was a rational, methodical system designed to make sure that money was put to work right away and effectively, with this steady stream of funding year after year. It's pure Buffett, a practical, results-driven approach to everything.
His logic was just pure, unadulterated pragmatism. I love this quote. As he put it, why would you try to invent a brand new golf swing when you can just hand the club to Tiger Woods? To him, the Gates Foundation was already the best in the world at what they did. They were scaled up, they were proven, so why don't just give them the resources to do even more, right now? It just makes sense.
But, you see, this decision, it wasn't just about the numbers on a spreadsheet. It was really the culmination of a philosophy that Buffett had been building and refining for decades. A philosophy that touches on everything from family to the very fabric of a just society.
Ah, a classic Buffettism, right? And it gets right to the heart of what he believes about fairness. He's always said his kids basically won the ovarian lottery just by being born. So to him, just dumping billions on top of that, it would be like giving a marathon runner a 20-mile head start. That's just not his idea of a level playing field.
And this is where the story takes a really personal turn. For years and years, Buffett's plan was simple. Let his wife, Susie, handle all the philanthropy after he was gone. But when she tragically passed away in 2004, he had to face a completely new reality. It was a moment of incredible loss, for sure, but it was also a moment of clarity. He realized there was no more time to wait. It was time to, as he said, step on the gas.
And just to put this into perspective, Buffett's gift, in today's dollars, is actually bigger than the combined giving of industrial giants like Andrew Carnegie and the Rockefellers.
It's like a 21st century version of Carnegie's Gospel of Wealth, a powerful statement that the fortunes built in a society should in the end be returned to that society.
Now this is where Buffett really threw a wrench in the works of traditional philanthropy. The spend-down mandate is a radical idea. It's him saying, look, this money isn't for building some legacy with my name on it. It's for solving problems and solving them now. It's a direct shot at the idea of foundations that just exist forever, a warning against the kind of bureaucracy and mission drift that can creep in over time.
Okay, so to truly appreciate the gift, we really need to understand the mind that made it all possible. And, there's no better stress test for a brilliant mind than a global financial crisis. So let's rewind to 2008, a time when the world felt like it was on the brink, and see how Buffett navigated that chaos.
Buffett has this surprisingly simple way of taking the market's temperature. He just looks at the total value of the entire stock market and compares it to the country's gross national product, or GNP, basically all the goods and services the country produces. When that ratio gets way too high, he gets nervous. But when it gets too low, he gets very, very interested. And believe me, in 2008, it got very low. Be fearful when others are greedy, and greedy when others are fearful. It's probably the most famous line in all of investing. And in 2008, Buffett put it into action in a huge way. While the rest of the world was panicking and running for the exits, he saw a once-in-a-generation buying opportunity. It was time to be greedy.
So you have to ask yourself, how did we get into that mess in the first place? Well, Buffett's answer was pretty straightforward. We just made things way too complicated. He looked out and saw a financial system that had become so complex, so murky, that even the people supposedly running it didn't seem to understand the crazy risks they were taking.
Buffett has a simple rule. If you can't explain it simply, you probably don't understand it yourself. And when he looked at the crazy financial instruments that caused the crisis, he saw a whole lot of things that nobody could explain simply. As he said, you can't just take a pile of junk, wrap it up in a fancy package, and magically pretend it's gold.
And look, this belief in the power of simplicity, it wasn't just a talking point for Buffett. He was so confident in it, so sure of it, that he made $1 million bet to prove his point. It was a 10-year wager that would pit his entire philosophy against the best and brightest minds in the hedge fund world.
And get this, the timing was just incredible. The bet started on January 1, 2008, right before the market completely fell off a cliff. Talk about a stress test. On one side, you had a simple, cheap S&P 500 index fund. On the other, a hand-picked portfolio of the most sophisticated hedge funds on the planet. The stage was set for a decade-long showdown between simplicity and complexity.
Now, Buffett's argument wasn't that he was smarter than all the hedge fund managers. He knew these folks were brilliant. His argument was about something much more fundamental. It was about math. Hedge funds often charge these huge fees. You've probably heard of 2 and 20. Buffett's point was that those fees create a massive drag, a hurdle that's almost impossible to clear, even for the smartest people in the room.
But the other side, they had a pretty compelling counterargument. They said, hey, a skilled professional like us can sort the wheat from the chaff. They weren't betting on the average hedge fund. They were betting on a curated selection of the absolute best, believing that superior skill could more than make up for the higher fees, especially when the market went south.
So when you take a step back and look at the whole picture, the philanthropy, the crisis investing, this big bet, you start to see a common thread running through it all. It's a set of simple, incredibly powerful principles that have guided Buffett his entire life. It's his playbook, not just for investing, but for living.
People are always asking Buffett for stock tips. His answer is always the same. Don't try to be a hero. Just buy a piece of the whole American pie, a low-cost index fund, and keep on buying it month after month, year after year. He says the only way you can really get into trouble is by paying sky-high fees or by letting your emotions get the best of you.
And you see this playbook and how he runs Berkshire Hathaway. He's built this incredible culture of trust and autonomy. When his partner Charlie Munger told him to invest in a Chinese car company he'd never heard of, Buffett did it. Why? Because he trusted Charlie. When the financial crisis hit, he gave his top people the power to make bold moves because he knew they needed to act fast. But there's one thing he never, ever compromises on: integrity. For Buffett, your reputation is everything.
So in the end, Buffett's story leaves us with this really powerful question. And it's not just for billionaires. It's for anyone who's ever created something of value. And the question is this: what's the ultimate purpose of all our work? Is it just to accumulate more stuff? Or is it to create something that's going to outlast us? Something that's going to make the world just a little bit better for the people who come after us? It's a question worth thinking about. And it might just be the ultimate lesson from the life of Warren Buffett.
So, what if the world's richest people held a secret meeting to try and solve the world's biggest problems? Today, we're going to pull back the curtain on one of the most ambitious philanthropic projects in history. It's a campaign that actually started in the shadows and grew into this global challenge to redefine the whole purpose of wealth. Our story really kicks off back in May of 2009. Whispers started leaking out about this clandestine gathering of billionaires right in New York City. And who was behind it? None other than Bill Gates and Warren Buffett. You can imagine, the media just went into a total frenzy. But nobody could seem to get the story straight. What on earth were they planning? And the speculation was just wild. The Chronicle of Philanthropy called the whole thing unprecedented. ABC News went with the more mysterious clandestine. But then you had one radio broadcaster who took it to a whole other level, painting a much darker picture. He told his listeners, "Ladies and gentlemen, there's mischief afoot, and it does not bode well for the rest of us." Yikes. So what was really going on behind those closed doors? Well, to find out, we're going to investigate this story from the inside out. We'll start with that secret meeting, then we'll look at the massive problem they were trying to solve, how their pretty audacious solution took shape, and what it all means for the future of giving. All right, let's get into it. Okay, first things first, forget the conspiracy theories. The story actually begins with a pretty simple idea from Warren Buffett. He just thought, hey, a small group of really dedicated philanthropists should get together and talk about a simple question. How do we spread the gospel of giving to others? Bill and Melinda Gates loved that idea and just ran with it. The guest list for this first supper, as you might call it, was an absolute who's who of American wealth and influence. It was hosted by the patriarch of philanthropy himself, David Rockefeller. And the format? Super simple. Just go around the table and for about 15 minutes, share your own personal journey with giving. People talked about everything from education to the environment, even how emotionally difficult it is to go from making small gifts to just massive ones. And by all accounts, the nearly 3-hour session was absolutely riveting. The goal here was absolute secrecy, but that secrecy got completely shattered just 2 weeks later when the story broke on a little-known website, irishcentral.com. Now, it's widely believed the leak actually came from inside the room, from Chuck Feeney, a man who had, get this, already given away his entire multi-billion-dollar fortune. The article sparked a media firestorm and forced the organizers to put up what their own camp called a cone of silence for the next year. Okay, so we know what happened at the dinner. But why was it even called in the first place? This wasn't just some friendly chat over a nice meal. No, this was a call to arms. It was the beginning of a campaign to solve a staggering problem, a massive gap between the fortunes of the super rich and the money actually flowing to charity. The campaign's target was crystal clear, the super rich. They started with the Forbes 400 list of the wealthiest Americans. And back in 2009, their combined net worth was a mind-boggling $1.2 trillion. So the goal that emerged from all these discussions was, well, it was incredibly ambitious. They wanted to convince this group to pledge at least half of their net worth to charity, either during their lifetimes or when they die. The math was simple, but just staggering. 50% of $1.2 trillion is $600 billion. That was the prize they were chasing. But how much were they actually giving at the time? Well, IRS data from 2007 showed that the 400 biggest taxpayers donated about 8% of their income. Now think about that for a second. That's kind of like giving away 8% of your annual salary. The giving pledge was asking for 50% of your entire life savings. That's the giving gap they were trying to close. It was so clear there was this massive opportunity to change the whole culture of giving at the very, very top. So faced with this enormous giving gap, Buffett and the Gateses realized they needed more than just a few quiet dinners. They needed a powerful, public idea to really formalize the discussion and turn all those good intentions into concrete action. And the answer was the giving pledge. The idea is just brilliant in its simplicity. See, it's not a legal contract. You can't be sued if you don't follow through. Instead, it's a moral commitment. A public promise to give away the majority of your wealth. It was designed to create a whole new social norm among billionaires, making large-scale philanthropy the expectation, not the exception. Now, the pledge wasn't just created overnight. It was carefully cultivated. After Buffett's initial idea, the campaign moved forward with a series of secret dinners in New York and California. And at these follow-up meetings, Melinda Gates says they would float the pledge idea to see if it would fly. Well, it floated nicely, and so the strategy was set, and it all culminated in a public website where the pledges would be posted for the whole world to see. To truly understand the deep, personal motivation behind the giving pledge, you really don't have to look any further than the letter from its most famous and enthusiastic advocate, Warren Buffett. He didn't just ask others to give, he led by example in the most dramatic way possible. So while the pledge asks for 50%, Buffett went much, much further. He publicly committed to giving away more than 99% of his entire fortune, a sum we're talking about in the tens of billions of dollars. And in his letter, he explained exactly why he was doing it. But here's what's so incredible about this. It's Buffett's humility. He points out that for millions of ordinary people, giving to their church or a charity means giving up something tangible, a dinner out, a movie. But for him, giving away 99% of his wealth, he says it's no real sacrifice. He's very clear. His family will give up nothing they need or want. Their lifestyle will be completely untouched. So where does this impulse come from then? Well, Buffett attributes his extraordinary fortune not just to skill, but to winning what he famously calls the ovarian lottery, the sheer luck of being born a white male in 20th century America in a market system that, as he puts it, produces distorted results, rewarding a savvy investor with billions while a great teacher just gets thank you notes. He feels not guilt, but this profound gratitude, and with that, an obligation to give back. So, with dozens of American billionaires signing on, the campaign turned its attention to a far more complex challenge: exporting this very American idea of public philanthropy to other parts of the world, specifically to the new centers of wealth in China and India. And this was not an easy sell. In a country like China, the whole idea of public philanthropy ran up against some really deep-seated cultural and systemic hurdles. You've got a strong tradition of dynastic wealth, where your primary duty is to pass your fortune down to your kids to ensure the family's legacy. On top of that, a history of scandals has created this deep lack of trust in charitable foundations, and the tax laws don't really encourage large-scale giving. But this right here shows the potential for a real generational shift. Warren Buffett's son, Peter, became this unlikely celebrity in China. His story of dropping out of Stanford to become a musician, using a small inheritance to follow his passion instead of joining the family business, it really resonated with young people. One young banker, after hearing the story, said wistfully, "Maybe someday my own child can have that choice." It just shows that this idea of using wealth for personal fulfillment and for societal good is beginning to take root. So, what's the ultimate takeaway from all of this? The Giving Pledge isn't just about a list of names or a dollar amount. It's part of a much larger philosophy about how wealth is created, what it's for, and what its ultimate legacy should really be. And this comes through so clearly in Buffett's own thinking. When it comes to earning money, his philosophy is to invest in productive assets. Businesses, farms, things that create real value and will keep doing so for centuries. But when it comes to giving money away, his philosophy is the complete opposite. He wants the money spent now on current needs. He specifies that nothing from his fortune should go into permanent endowments. Wealth, in his view, shouldn't just be sitting still. It should be actively working to solve society's problems. And that leaves us with a final and pretty provocative question. The Giving Pledge has shown that a public promise can change the behavior of billionaires. So what if we all made a public pledge? Maybe not of our money, but of our time, our skills, our attention. What could we achieve if we all decided publicly to give something back?